Friday yesterday. It was like, and then, so what's gonna happen
What's that?
was.
Yes. Everybody use those mouse pads because they're more than
I
mouse
got mine in my
pads.
book bag.
They protect your PC when you close it. They're microfiber for you to clean your screen. They're kind of cool. Got those from one of my clients, Lemonade Creative Marketing. And that too. So look, I want to thank everybody for coming out. For those of you that are new with First Financial, this is something that I do every year because I think it's really important at the beginning of the year to get with clients and give them as much information as they can get in order to run their businesses better for this year. You know, sometimes people tend to meet at the end of the year only and talk about last year. So we have the agenda and we'll stick to that agenda. If you have any questions along the way, certainly ask those questions as they come up. And it is not a problem at all, okay? Unfortunately, there will always be one area that doesn't apply to somebody. Maybe you don't have a W-2 employee or maybe you don't have a 1099 person, but that's okay, okay? And again, take notes if you want to. After this meeting is over, I'm going to email you Amanda's PowerPoint and my PowerPoint. I'm also going to go ahead and upload this to my YouTube page, which by the way, if you go to YouTube and just search First Financial of Baton Rouge, you will come up with the page, and there are videos on there from past presentations that I've done in different places or different speeches I've given, so those might help out, okay? So the first thing I'd like to do is, if you wouldn't mind, if you could just tell us your name and your company you own or what type of business it is. So start with you, Jen.
Hey, I'm Jan Fleming, Accurate Medical Billing.
Andrea Lafayette, I'm actually here for Truth, Personal Advanced Care and Accurate, Care as well.
Cut the donut. I'm Dave Pennington, here really on behalf of my wife. I usually handle the tax part of it before I turn it over to you. And, company's Excellence in Speech Pathology. And,
Okay.
Jamila McKee, I'm a private investigator and owner of JMAC Investigations and Solutions.
That's my
name.
sister's
You
name,
cannot-
Jamila,
you
as
cannot
well.
do
Spelled
anything else.
differently. That's why she was here.
Todd Gianfalo, the company's Gardens and Grounds, landscape maintenance.
Me.
Yep.
Cody Louviere, King Crow Studios. We do digital media, virtual reality training.
Gabe Gillum, Gillum Lawn Maintenance, landscape maintenance.
Excuse me. Richard Spears, Prime Properties team, real estate team. We do residential, commercial real estate.
Angelique Williams, I'm one half of Lead Medical Transit, which is a non-emergency medical transportation company, and also a realtor with Eloise.
And then in the back is Rochelle. Rochelle Peter, she is one of our accounting people here. Works for our monthly accounting department, so some of you, she probably handles some of your things in the background, okay? So the first thing on our agenda though is one of the things that always concerns me, and I say this time and time again, I know I overstep my bounds sometimes as I suppose it's just accountant or tax preparer, and get into your personal lives a little bit too much, telling you what to spend money on, what not to spend money on. But I, you know, I kind of feel like that's my responsibility because I see your financial picture better probably than anybody else. So one of the things that I do definitely always have realized is that people who are self-employed do a very poor job at preparing for their retirement or preparing for the future. It's not like a job where you're going to have a 401k you can belong to. You know, it's really self-directed. So I've asked Amanda to come and speak for the first part to talk to you about some different options, clarify what types of options are available for self-employed people in terms of preparing for their retirement. Okay? So let me bring this up.
I'm honored to be here and have my company, Minshew Radasta Wealth Management, come up here.
A little bit of a background on me quickly is I've been in the industry since 2002, and my business partner Linda and I have been in business since 2008, right before the crash. So that was really fun to open up a business of financial planning at that time frame. But anyway, I wanted to come in and really just talk to you guys a little bit about what's available out there and a few of options that might be something that you could look into, and then of course that we could work together directly with Amin in your financial picture. So first, there are traditional retirement planning types. We have individual retirement plans. You might have heard of them, IRAs, something like that. So we have a traditional IRA and a Roth IRA. The company plans that I think are most important for business owners like yourselves are a simple IRA, the SEP IRA, a 401k option, and then of course there's an additional Roth 401k option as well. Now, one of the things that we really want to look at when we're looking at individual retirement plans are what are the main differences between a traditional IRA and a Roth IRA. And really it's just the taxation of it. So when you're funding a traditional IRA, those tax deductions can be taken in the year in which you actually put and contribute those funds into that account. On a Roth, the money is after-tax money. But the really great thing about it is both of them grow the entire time, tax deferred. And then when you pull the money out of each of them, that is also how the taxation is affected. So with the traditional, the distributions are going to be ordinary income. With a Roth, all of the earnings and the growth in the account are all going to come out tax-free. So a lot of times people really want to say, well, boy, don't I just want to put everything in that Roth so when I get in my retirement years, I don't have to pay any taxes on the money that comes out. So there are some options that we can look at next in terms of how you would be funding those. So there are a few rules about these two types of accounts, the traditional and the Roth. They both have the same funding amounts, $6,000 annually. That is for inflation, adjusted for inflation on an annual basis. And the $7,000 is what they call a catch-up provision. So that gives you an additional $1,000 if you're 50 years or older. So if we've maybe waited a little bit of time and we really want to start funding a little bit more at that 50 years or older mark, that's what they give you. The other couple of main differences there is that, as I said, most people want to say, okay, well, why don't we just put everything in a Roth so that I get all my money out tax-free? One of the situations we have to look at is, do you need a tax deduction that year? Do you need to reduce your income for your company that year? If you do, then you're going to want to use a traditional. But additionally, in the Roth section, there are limitations to the amount of income that you can have to actually contribute to that. So if you're an individual that's filing a single return, that's you have to make less than $137,000. If you're filing a joint return, married filing jointly, that goes up to the $206,000 level. There's also a phase-out period for a short period of time before that, but that's what really sort of limits that, because the government doesn't want to not get tax money on growth of an account, so they're going to put those limitations there. Additionally, contribution amounts at different time frames, and then the required minimum distributions. The main rule too, as well as far as withdrawals, 59.5 is on the traditional. That's very similar to your traditional styles of 401k plans or anything like that. They require you to wait till 59.5 to pull out the funds without a penalty. And then, of course, the contributions you can pull out on a Roth at any time because you've already paid taxes on those, but you do have to wait to 59.5 or 5 years, whichever one is longer, for any of the earnings to come out without having to pay taxes on those dollars. But one of the things that has changed this year, that's a new tax code that was passed, I'd like Amin to sort of talk about that, is some of these numbers have changed.
Yeah, so there was just recently a tax law that passed that changed a few of these items. One of them is that they've raised the contribution age limit to 72, so you can contribute up until age 72 now. Also, they moved up the required minimum distributions to 72, and those are the two major things there. The other major part that changed is that traditionally when you had an IRA, if you die and you leave it to a beneficiary, that beneficiary didn't have to start withdrawing until 70 and a half. So, you know, if you were Edwin Edwards and had an IRA and you have a son that's 7 years old, that person had 63 years before they had to start taking money out of it. And if they died before 70 and a half, their beneficiary got it. So what happened is, for, IRA money would just sit there and the government would never get its interest or its taxes on it. So part of the new plan is that the monies have to be withdrawn by beneficiaries within 10 years of you leaving it to them. So, and that's even if you leave it to somebody and they die 5 years later, whoever inherits it from them has only 5 more years. So it's gotta be completely liquidated. It used to be a provision called the stretch IRA, but they've now eliminated the stretch IRA to make sure that they get their money within 10 years after you die.
And the one thing to bring up there as well is that a traditional IRA could have a really large sum of money in it at a later date as you've been putting away funds. Even though the contribution amounts they look $6,000, it looks like, well, how could that grow very big? Well, there are companies, if you have a 401k plan that you get ready to retire, any sort of tax deferred retirement plan, they're typically rolled over into a traditional IRA upon retirement, because you can own almost anything in a traditional IRA. You can even own property, land, anything like that inside of that. So those dollar values could grow immensely. So you could be looking at $5 million account or more, and that has to be given to a beneficiary, and those dollar amounts have to be pulled out in that 10-year time frame. So that could be a lot of tax situations that are a lot higher than what they used to be with the stretch provision. So,
Can I ask you something?
yes, absolutely.
On traditional, it's tax deductible, or is it taken off your aggregate income? And then your
It's what's called an above the line deduction, which means
Okay.
when you take your income, you subtract it before you even start to calculate taxes, so.
So that's why when I had said earlier, you really need to look at your tax situation, and if you need that tax deduction in that year to reduce that bottom line, well, that's why you might choose that traditional versus the Roth. So on the company retirement plans, we're looking at the simple, the STEP, and then the 401k will be on the next page. But the simple and the STEP, I think one of the things and the reasons why most folks who own businesses and decide, okay, let's go ahead and start some sort of plan, they want to start one of these because it's very easy to start up, and there's not a whole lot of reporting or red tape that you have to deal with in the government in terms of testing and things like that. The simple, you have to have less than 100 employees, and the STEP can be any size. I think two of the things that are really most important there too are the fact that a simple has both employers and employees that can contribute, just like a 401k would. So that's one of the components that it's like the 401k plans. While the STEP, only employers are there and being able to put monies away. Additionally, the funding amounts. It sort of flip-flops on that side, where the STEP, you have up to $57,000 you can put it into that, and that's the limit of a 401k, whereas the limit amounts on the simple are a little bit less there at the $13,500 and the $16,500 for the 50 or older category. The simple allows for adjustable cash flow. You're not, really locked into any one thing, which is one of the reasons why that is also sometimes chosen, because we look at cash flow when we're originally setting up a plan, and we're kind of like, okay, do I have the money? Is this something that I can move and use around or make adjustments to? Whereas the SEP is a little bit more structured, like the 401k plan, where there is actually a percentage match that you're looking at in different arrangements there. So I think that, there are some provisions on the STEP where the employees only, the employers only put away the funds. You can have 2 years where you don't contribute to your employees, if that's the direction you go, because let's say you have a couple of years where you're having a really good year and your income is up, and so you really want to be able to sort of super fund your retirement at that time frame. Additionally, both of these can be stopped at any time. You're not stuck with it if you open it. You just can't have both of them in 1 year. You have to use one for one tax year and then another one for the next tax year. So the retirement plans for companies, also 401k, again, like we had mentioned on the last slide, the plan document design and the ERISA testing are what sometimes hold up people from really actually deciding that that's exactly what they want to do with the 401k plan, because there are, some plan document designs that you have to put in place, and then of course you have to have testing to make sure that the high income earners or the folks at the top are not, putting away all their money and leaving the guys at the lower areas sort of out in the cold. So that's what those ERISA testings are for. Again, employers and employees are able to contribute to that. The contribution limit for the employees is the $19,500 or $26,000 for 50 or older. And then of course that max, like I was talking about before with the SEP, you can contribute up to $57,000 with both contributors, both employee and employer. So, it's definitely a little bit more structure to this plan, but there are also some profit sharing options that you can add on to these. And of course you could add on, the Roth section of your 401k, and those contribution amounts on the Roth would be that same amount, the 19.5 and all of those things. So you'd be able to fund it more than just your traditional retirement plans as we discussed before. Now, one of the main reasons that Amin actually wanted us to come in and talk about this is because the alternative executive retirement planning is what we really wanted to look at here. And that there are about 7 different types that are out there that can allow us to discriminate against other employees and or pick out one. Let's say, for instance, you have somebody that is very valuable to you in your company and you want to provide an opportunity to keep them around. Well, you can go and specifically identify that person and say, I'd like to give this key employee an executive bonus, or I'd like to just start up a non-qualified deferred compensation plan, which is just another type of retirement plan. But you don't have to give it to everybody, and you can give it only to yourself or those key employees. So that's one of the things that I believe that was something that Amin and I came across when we were working with one of his one of his clients, and the employee was trying to maybe keep this key employee and have something that would be comparable to what the state was going to be offering them for retirement. So we're going to go to the handout that I gave you, and I'm sorry I stepped up here and forgot to bring it up. So what this is, and I'm going to go through the numbers for you, sort of at a high level, but basically this is a life insurance retirement plan. So it is funded with life insurance, but it is something where you're able to put a large dollar amount of money in for a number of years, and then leave it in there and allow it to grow for a specific amount of time. Mainly they want you to have about 10 years time frame that you fund it, and then they want you to have 10, 15 years to allow it to grow so that the value of the dollars that are in there are going to grow and you'll have the ability to pull it off. I don't know if any of you have ever heard other folks say, well, I'm going to go borrow money off of my life insurance plan. I've got some cash value that I've built up in there, and this is going to allow me to, pull a little bit of money out that I need. Well, that's similar to what this is. But in this situation, it's a government code section 162 that allows for us to be able to, as employers, be able to put money away for the executive, write it off if you're wanting to do that key employee and get that key employee a bonus. You'll be able to reduce that company income. But we'll look at the first portion here on the far left side. This is an actual client that Linda and I put together. The individual was a male, 37, and his tax rate was 28%. And so this is very fluid, meaning that it is based on gender and age and things like that. One of the other things is there are less requirements. If you have 10 or more people, everybody passes the health. There's no health test whatsoever. So in that situation, if you're really wanting to go in there and do that, because you might say, oh, well, they have to pass the health test, I'm not going to be able to do this for them. Well, if you have 10 or more, then there's no health test whatsoever. If there are 3 or more, it's just really kind of a phone interview for cognitive testing to make sure that they're not forgetting things, different things like that. So if you look in this situation, he's a little bit younger. So as I said, Typically, you wanna do it for that 10-year time frame, but in this situation, we just did it for 7 years because he's younger, and we're gonna run it out until age 65. So the total amount that we have, that we've put in there is $105,000. And if you notice, the executive bonus is $15,000, but the actual cost to you as an employer is only $9,900 because of the fact that there are taxes that are gonna be paid on this by the executive, and you're gonna be reducing your company cost by being able to give that bonus out to them as a W-2 form or whichever way that you, and we would discuss that with Amin, how we would set that up. And in some cases, people might say, okay, well, why would they want to not receive that income, but actually have to pay the tax on it? Well, what that tax would really essentially do is look like and be very much so a premium for the insurance. So if you look at the far right line, a column over there, it's over $457,000 in insurance immediately, of which all of these individuals are able to pick their own beneficiary for this to go to. So in that sense, you would just kind of say, okay, well, really, this is just the cost of you having this insurance. While that's not the primary goal of this specific plan, it is an ancillary benefit for that. So if you flip over to the next page, and we go down and we look, we've allowed this to grow the net surrender value is what that cash bucket has grown to. So that's what the value of the policy is right there. And then you're at age 65, we start pulling out just over $47,000 a year. Now the main thing in this situation as well is that this money comes out tax-free. So remember when we were talking about a little bit earlier, we wanted to maybe super fund a Roth where we could have tax-free income. This is the way that you would be able to do that, because of the fact that there is no limitation on the amount of money that you can put in, and it's very fluid where you can make different decisions. Additionally, you're not stuck with it in terms of if you start saying, I'd like to put $10,000 a year and you start the plan, the next year you don't have as much cash flow, you don't have to fund it. It doesn't blow up the policy. Of course, it reduces the amount if you never fund it again of what you would be able to pull out tax-free during retirement. But then say the third year, your cash flow comes back. Then you could go ahead and then continue to fund that. So in this scenario, we're looking at the little over $47,000 in tax-free income coming out to you, but that directly reduces your death benefit at that point. So, it correlates because you're pulling off of the cash value of the policy. And so there's, that's basically where that death benefit is being affected. Just like if you have any other type of insurance policy that you went and borrowed the cash value out, there'd be a death benefit plus the cash that was in there. Well, that cash, if you pull it out, that's not gonna be paid out to you at that time. And in this scenario, we just run this for age 65 to 77. So, there's no real exact date. You don't just do it for, fund it for 10 years and then pull the money out for 10 years. You can start and stop at any time. So it's just an alternative way for you to be able to really look at yourself as, an employer and be able to go in there and say, okay, I really need to start putting something away for myself. Ancillarily, it gives you that death benefit, even if you don't need it, it is part of the plan. And then if you have those key employees, you can specifically identify throughout your company. So it's a really great tool. So,
Okay. So that's almost like building a pension for yourself, except that it would also be tax-free at that point. So they put in $105,000, but they got to pull out $47,000 per year for 10 years. It's $473,000 you're able to pull out. Okay, so again, it's a way to supplement your Social Security or whatever else you're going to have by the time you go. So basically, she can take any scenario. She'll take your age, your sex, and you guys will talk about it and say, okay, work me up a plan where I contribute for 10 years or 15 years or whatever you want. The longer you contribute, the less you have to actually put in each year. And then I want to start taking it out at, say, 62 years old or 65 years old, and I want to take it out for 15 years until I'm 80. So you tell her the scenarios, and she can put together the exact amounts that you need to put into it each year and how much income it would generate for you when you're ready to retire.
One
Just
other,
a
I'm
neat
sorry.
idea. No,
I was just gonna say, one other thing that I forgot to mention, because all of that is directly just for you as the business owners. But if you did find a key employee, you might be saying to yourself, well, what is it if I give this, policy to them and they just walk away the next year? Well, there are restrictions that you can put on these things. So you can put in there that they cannot put a loan on the policy, they cannot put it for any collateral, they're not allowed to draw any cash value out until age 65. There are all these things that you can, put, sort of have strings attached to it, so they wouldn't be able to just walk away with the benefit that you gave them. So we'll go to the next slide. Finally, what we feel really passionate about, both at our office and then obviously working with Amin, we feel really passionate about strategic business planning on an annual basis. The business plan is one of the things that most people sort of shy away from, and the reason why is they feel like it's cumbersome, or you just don't have time to do it, or for whatever reason, just I'm not feeling like this year I have time to go in and really identify all the things that I want to do with my company. But if you don't do that, it's kind of like going to the grocery store with, out a list for a recipe. If you're getting ready to make something and you just have it in your head and you go grab all the things, you might end up at home and you don't have the main ingredient. You're not going to be able to, make that specific dish. So if you're not able to check off that list of things that you actually need or want to accomplish in your company as well, then maybe they're still up here in your head, and you look back 3 years, or you're like, 3 years ago I wanted to do this. Why didn't I put this in place? Well, generally it's because you didn't write it down and you didn't have a checklist, a to-do list, so to speak, to be able to mark that off and make sure that you achieve that. Because that's what's going to be able to maximize profits and reach those short and long-term goals within your company. The next thing I think that we all feel is very important is that you need a business continuity plan. You need to make sure if there is an emergency situation or if something comes up and you can't be available to your company, how is your company going to run? What's going to happen if you're not there for a period of time, or if your individuals that are purchasing from you are not able to purchase? We all know with Katrina and the recent flood that we've had, we might have a little bit of an issue in terms of how our companies work. And so what you really want to do there is make sure that you put those procedures and policies in place, so if something were to happen, either emergency-wise or if you weren't able to be in your company making the decisions, that they're going to still run smoothly and that your company will still be there. Additionally, the business interruption insurance is something I believe that most people should at least look into. You can work directly with your insurance agent that you deal with on either a personal level or on your business level. And that's going to vary in terms of how much it's going to cost based upon how much you need every month to bring in, whether it's just overhead for your company or income that you need coming in the event that your business is closed for, say, a month while you rebuild after the flood, something like that. Then finally, the wealth transfer planning is something that Linda and I really feel very passionately about, and one of the main reasons that we went out into the independent financial advising world. And that's because we're able to go in and look at your picture as a complete whole, work with individuals directly like Amin and all of the other financial professionals that are in your life that will actually know your situation and make sure that we all stay on the same track to meet those goals. And so for you guys who own your own businesses and you're in this situation, you might want to look at, well, what do I want long term for my business? Do I have a business partner, or do I want to transfer it to my children? Do I want to sell it outright in the marketplace? And those are, or do I just want to close the business at that point? And so if you're transferring your business to your children, something like that, there are a lot of different things that you can do to make sure that it's done in a very smooth and most tax effective and efficient way possible. There's something called estate freezing, where you can sort of put certain shares of stock on non-voting and voting, and you can move those shares of stock over to your children or whomever in your family that you would like to pass these things to. So it removes growing assets in your estate outside of that, so it reduces those taxes. As well, if you're selling your business, that's when you're gonna wanna have a valuation. You're really gonna wanna know, how much is my business worth? What is my multiple? You know, how do I go out and attain and attract people to actually sell my business to? And finally, one of the things that is actually very, very important is everyone needs a will. Regardless of whether you feel like you have a huge amount of money or a small amount of money, but especially with your businesses, it could get very, very messy. And I happen to have personal, knowledge of this. My father died without a will. And so my mom and dad didn't own businesses at the time that we needed to, do those things with. But my sister and I got 50% of what my mom and dad had because there wasn't a will, and we live in the state of Louisiana. It's a community property state. So half of that came to us. So we had to sign a document to disinherit ourselves, basically, and give that 25% from each of us back to my mom so that she could have that. So in that situation, you just want to make sure that you don't have that messy situation without having a will in place. And they're not very difficult to do. Some can be somewhat complex depending on how many companies you own and what formats you own them. But it's definitely something that should be looked at on an annual basis. If you don't have it, you need to get it done, and then you need to review it at least once every 5 years. So, those things are really important for strategic business planning, and just, especially since I have personal knowledge about the wills, I think that it's simple to do, and everyone needs to take the time out to do it. So I don't know if you guys have any questions, or if you think about something later, Amin is going to be forwarding this slideshow over to you, and then I'll also be reaching out to you in a few weeks just to kind of see if there's anything that you thought of that we discussed, that you thought of later that maybe you have a few questions about. So thank you very much for having me today, and I hope the rest of y'all's meeting goes very well.
Thank you.
All right, I don't know if we're gonna go to the fun part or the boring part. So, I asked Amanda I'm gonna share your emails with her or whatever, and ask her to follow up with you in a couple of weeks, see if something set in, you have any additional questions. I've put a lot of faith in them. I think they do a really good job at advising. So we'll move on. So again, we're gonna go ahead and start with the first financial portion of this. And we've already done the retirement investment. We're gonna spend a little bit of time talking about what you need to do to help you prepare for your 2019 tax filings. We're gonna go into some tax law changes that are going into effect or have gone into effect January 1. We're gonna talk about general law changes from 2020 that have gone into effect for this year. We're gonna spend a few minutes talking about succession planning, and then we're gonna talk a bit about controlling expenses to be more profitable in 2020. And everybody knows that's kind of where I play. I started this business as a business consulting firm. It wasn't started to do accounting or taxes. It was to help people fix their businesses. So that's really where my passion is, okay? So for 2019, along with in the email that I sent you that told you about this, there were your tax organizers attached to the top. Most of you are my previous clients. Maybe one, no, maybe I just need, well, we might have one new person. So at any rate, that tax organizer should be filled out, even though I have your information, okay? Situations change from year to year. Everything that's on that tax organizer is a potential discount for you on your taxes, okay? It might be that somebody in your family has been recently deemed disabled. It might be that, anybody have a safety deposit box? If you have a safety deposit box, that's deductible. I need to know these things, and those aren't things that I'll see in your typical documents like 1099s or W-2s or your financials we do here. So fill out that tax organizer for me. It will just, again, make sure that I don't miss anything. Gathering documents. At our house, our center aisle in the kitchen, the end drawer we designate as our tax drawer. So as 1099s come in, interest statements from your mortgage, interest statements from the bank, from savings accounts and things, we just open up that drawer. If my wife sees something that says important tax documents, she doesn't even open it, she just drops it in the drawer, right? So whether you have a box or something, just keep organized, just throw everything in it. When you bring it to me, I can't stress this enough, I do not need you to organize it. I don't need you to, I have one client I teased here she came the first day, which I knew she was gonna be signed up for the first day, the first session. But she every year alphabetizes all her documents. She gives me a spreadsheet with each one of them typed on it and listed and then totaled and in this binder with, and you know what, when I give it back to her, it's just I just hand her all the papers, okay? Because when I get paperwork, I'm entering each thing into the tax software, so it doesn't matter what order I put it in, none of that, okay? So save yourself some time and some headache, but gather your documents, keep them in one place. The only thing we can truly do to reduce your taxes now that we're past December 31st is whether or not you're able to contribute to an IRA. So there are some restrictions, you have to have certain amounts of earned income and things like that. So what typically I like to do is we will see what your tax returns come out to be, and I'll let you know this year if you can put some extra money in an IRA, how much difference it will make, either in your refund or reduce the amount that you owe, okay? And then you make that decision. Even if we file your tax return on February the 10th, which tax season opens January 27th this year, even if you file your tax return on February 10th, you've made the decision, you want to put the money in the IRA, you do not need to put it in at that point, you have until April 15th to put it in. So it leaves us time to do some planning, okay? I ask everybody to file early. First of all, if you don't know me, you will typically get to know that the day after tax season, where am I? Somewhere, on a beach somewhere, right? Okay, so try to file early, try to get me your stuff early. Yeah, based on scheduling and the things I have to do, you might get me the stuff today and it might take me a week to get your return done, but it shouldn't take that long. The earlier the better, okay? We're gonna strive for our 100% no extension goal. How many of you did we have to file an extension for last year? Okay, but two new clients really in filing, and then one was a unique situation. So, you know, we file a few hundred returns a year. We try to keep the number of extensions under about 10. So, you know, so let's try to do that. Let's try to get our no extensions goal going for this year, okay? All right, let's talk about some tax law changes. So, first of all, the major changes in taxes happened last year. So you probably saw a real big difference between last year and the prior year, one way or the other. The few people that it did help, you know, we did see some good benefits. Most people it ended up hurting, which, you know, is understandable. I'm gonna stay away from politics as much as possible. But, you know, we gotta remember that the government has to fund itself, right? We gotta pay our military, we gotta do all these different things. So, they're sometimes slanted, but, you know, compromises are made and things get done. So, we shouldn't see as big a changes this year, but the standard deduction did go up a couple $100 each one, well, $200 and $400. Individuals now, though, can transfer, they doubled this number, so I know that was a concern to most of you. You can now gift or in your estate leave up to $11.58 million and your heirs do not have to pay any tax on that, inheritance tax. It used to be 5.6, they doubled it to 11.58. So, you know, that's okay. Sometimes it takes some planning and some thinking, and maybe there are some assets you want to think about gifting to someone. So if that's a concern, just let me know. This year there is no health care mandate, so you will not be penalized as you have been in the past years if you do not have health insurance for the year. Okay? Here's one. Actually, I have one client it affects that I know of, and she's a lady. You can't deduct alimony payments anymore. So she was paying alimony to her ex-husband, and she can't deduct that anymore. Income brackets have been adjusted for inflation. That's what they said. I don't understand how, because they adjusted them by 1.6%, but inflation wasn't 1.6%. So I don't understand they made some kind of adjustment to account for inflation. So those are your brackets that moved your income levels up a little bit to determine what percentage you have to pay in taxes. Okay? Medical expense deduction has been raised to 10%. What that means is if you itemize your deductions, maybe you have big home mortgage, but don't forget, remember these went up. So like a married person has to have more than $24,800 in mortgage interest, property taxes, donations to charities, which a lot of people don't. That was the purpose of this, was to get less people filing itemized. But if you do itemize, anything over 10% of your taxable income, you can write off on your medical expenses. And that's policy costs, that's doctors' co-pays, that's surgical things, it's deductibles, prescription medicine. All of those things add into that, but you can only write off over 10%. So if you make $100 grand, you can only write off whatever you spend above $10,000. Okay? All right. And by the way, in case you don't know me, I will kind of keep clarifying until I see the eyes look like they got it, or I see a couple of nods like that, okay? So if I'm going on too long, it's because I'm thinking you're not getting it, so nod or eyebrows or something. Okay, fines and penalties to taxing agencies are no longer deductible. So if you pay because you filed your taxes late, you cannot deduct that from the business. If you pay your payroll taxes late, you get a penalty or interest on it, no longer deductible. So that's their way of trying to get you to give them their money faster, which you should do anyway. We typically don't have too big of a problem with that. Okay, any questions on those? Again, not a whole lot of changes from prior year. Virtual currency, anybody here deal in virtual currency? Cody's smiling because so, to put it simply, the IRS just said, we have no idea how to tax virtual currency. So right now, there's not gonna be taxes on gains or losses or if you donated, because we just have no idea how to do it. So to give you an idea, Cody and I had a venture where we had these computer banks, and he's a computer man. He just came and I was like, I don't know. So anyway, and companies basically could use those computers to verify transactions and calculations and stuff, and then they would pay us with Bitcoin or Ethereum or other currencies. Well, we haven't had to claim any of it as income, so they just don't know how to do it. So that's a good thing for right now. Taxpayer First Act of 2019. Okay, so here's the yes.
On like Bitcoin and stuff. What if you gain some stuff with Bitcoin?
Again, they don't know how to track it. They don't know how to account for it. Now, if it's a business expense that you're paying for with Bitcoin, let's count the expense, because we can justify and say, the current rate of Bitcoin at that point was X, and we paid this much to buy that company's or that expense. Okay. So this Taxpayer Act. So this is a compromise. I'm just going to tell you, the Democrats wanted to get rid of this rule, and the Republicans wanted to keep the rule, so they compromised in the middle with this act. So what this rule says is that if you owe the IRS money in any way, they can go out and talk to anyone they want about you and your business. They would go to neighbors' houses and ask neighbors, have they been throwing parties? Are they extravagant? Did they do any home remodeling? They would call the job and say, we're planning on garnishing their wages. You need to tell them to pay, otherwise you're going to have to do it for them. So they could contact any third party they wanted to, and just tell them your business, and basically try to bully you into, taking care of it out of embarrassment more than anything. So again, Democrats once said, passed a rule because they control Congress and said, we're not going to let that happen. They need to stop talking to people that have nothing to do with the taxpayer. And the Republicans said, no, this gets us our money. We need to let them keep doing it. So they passed this act. So what the act compromise is that they can still talk to anybody they want, but before they do that, they have to send the taxpayer a letter giving them 45 days to rectify their situation. Otherwise, they're gonna go talk to the people. So now it's just turned into blackmail. Right? Okay, but okay, that's better than what it was though, right? So now at least they give you notice and you'll get it, you'll see it. It's gonna, if you ever owe back taxes or anything, you're gonna get this letter and it's gonna, cause I've already had 2 clients that got it on their personal side cause they didn't pay their taxes when we did their return and stuff. So, and it says literally, you have 45 days, otherwise we are going to start contacting neighbors or any other third parties we feel will help us collect the debt. Yeah, I know, it sucks. All right, as I mentioned, the biggest change happened from 18 to 19, so we really shouldn't see a whole bunch. They are expecting to do even less refunds this year than they did the prior year, and you can see there were 300,000 less in 2019 than there were in 18. That's how big the difference that tax law made. And on average, the refunds were down $39. I know that doesn't sound like a lot of money, but when you take the number of people who filed returns that got refunds, that's a lot of money, okay? So they're expecting less people to get refunds, but we shouldn't see as big a jump as we
That's
did from
because
the
they're
prior
getting their money
year.
up front.
What's that?
They're getting their money up front on the paycheck. Right?
Well, no, there are a lot of things that go into it and figure, but one of the things that the IRS did last year is they sent out letters of what's called forced withholdings, where they sent a letter to the employer saying these people were not holding enough, because I have a client, and it was because he was withholding enough from his main job. He was an attorney, but he also did legal work through his own company on the side, and he was married with 2 children, young children. He claimed 4 as his withholdings, so that should be right, but he was not sending in estimated payments over here, so every year he has these big tax liabilities. So they wrote his employer and said, you must switch him to single and 0 for his withholdings, and they forced the company to do that, and they can do that. That's been something they could do for years and years. They just never did it. And we're gonna see that later when we talk about the W-4, that changes for this year. But people withhold more now because they owed some. People understand because, you know, when this tax law changed, nobody really did a good job at telling, I mean, I know I met with every one of our clients here, but people didn't do a good job overall of explaining to people, look, these tax brackets change, you need to change your withholdings. So they got kind of caught at the end of the year. So that's probably the biggest reason is employees withholding enough, but again, the businesses should be pretty similar to the year before. Okay? Failure to file penalty, it's called failure to file penalty, but it really should be called a late filing fee or something, because it's not failure to file, it's that you filed your return after the deadline of April 15th or October 15th or whatever it was.
Pay that with this extension.
So with an extension, you had until October 15th, and if you filed on October 16th, you saw the failure to file penalty, okay? But it was $125, you can see they almost tripled it. Again, more revenue. And you know, they're thinking, look, when politicians get together, their thinking is, well, guess what? If you don't want the penalty, just file on time, right? So that's kind of how they think about it. You know, it is what it is. Reasonable compensation. All right, most of you who we do a tax return for, unless you're, you know, kind of new in business or don't make over certain amounts, up until this year, they have this term called reasonable compensation. And that says that if you're gonna tax yourself as an S Corp, which basically means the money you take out of your S Corp, you don't pay the 15.23% self-employment tax on. Years and years, people just changed their corporations to an S Corp. They took no salary, so their entire earnings were not subject to self-employment tax. So the government came back and said, you have to take a reasonable salary. Now, in their infinite wisdom, they didn't define what reasonable salary was. So there was no sort of justification for it. And the truth of the matter is, they still haven't, but I'll tell you about that. So tax preparers like me would say, hey, take a $2,000 a month salary, that's reasonable, and move on. And then the rest of your money is not taxed that way, right? Completely legal, completely fine, completely free. But what happened last year is there actually were 3 court cases where the IRS took employers to court saying that the salaries that they took were not reasonable. Now granted, I understood one of them, the guy was making $3 million net profit in his company, and he paid himself a salary of $500 a month to run the company. So $6,000 over the course of the year, and you know what? The IRS prevailed. And see, they had always been really leery about the IRS court prevailing or making that ruling, because who's to say what's reasonable? And they never had an actual cutoff. It wasn't like they had a percent or a dollar amount or anything. So they didn't want to even rule on those crazy cases because where's the line? Okay? So what they did do though, because I do the IRS continuing ed each year because I get my continuing ed credits that I need to stay an agent with them, and I get to hear their secrets. They tell us what they're planning on doing this year, which is good. Okay? But they told us that they are going to more rigorously look at that reasonable compensation. They said that the tax preparer or the person advising the business needs to at least have some sort of methodology or thinking behind it on how they came up with that number, okay? They recommended that what we look at is how much would you have to pay somebody to do what you're doing for the job, for that company if you hire them? Or how much could you hire yourself out for if you were to go and get a job, okay? Figuring full time. So the easiest thing to do is us to look at the Department of Labor wage reports for this state, and it tells us what the average person is making. So like a real estate person is about $52,000. So we need to probably make your reasonable salary around $4,000 a month so we can justify it to the IRS. Now, that makes people say, well, maybe I should go back to filing as a Schedule C, not file the S Corp. You don't want to do that because you have to pay that 15.3% on everything up to $137,000. So even if we have to raise you to $50,000, you're still saving 15% of the $87,000, okay, or $13,000 is what you're still saving in taxes. So it's still worth it for us, but we need to evaluate that. I'm just kind of giving you a heads up that we should evaluate that for you guys, everybody that's filing as an S, which includes me. But we can make adjustments. So, for instance, I own multiple companies. So I obviously can't spend 100% of my time to each of these companies. So if I look at what an accountant makes in Louisiana, it's, I don't know, I think it was around $58,000 was the average or something. So I only put half of my time into this company because I dedicate time to others. So my reasonable salary for this would be $29,000. I have another company that's an S corporation that's still just in existence from when we did all of the BP claim work. And I don't do anything with it, we just periodically get in residual payments to it. So I'm gonna take $1,000 payment from that one because I can justify I don't spend any time on it and whatever. So we'll evaluate each person's individual thing, but we will need to make that change because they told us they're gonna be looking at this. We don't worry about audits too much. How many of you guys have been audited while you've been my client? I might have been audited before, that might be how you came to me, but I know I fixed some things for people that came to me. Look at Jamila going, y'all. Okay, so I've never had a client audited, so I don't anticipate you being audited, but the cold hard facts is the S corporation is the least audited return of all anyway. They only audited 10,000 of them out of about 4.1 million of them last year. And the ones that they audited were probably because they had some trigger on them, like they didn't pay any salary at all, or they didn't, do something like that. So we don't worry about that a whole lot, but we'll justify it if we need to. All right, this one, anybody here carry inventory? I don't think any of you guys do. Okay, at any rate, the filing method change though rule is one of the only rule changes that I agree with this year, which allows me to pick and choose each year whether you want to file your return on an accrual basis or a cash basis. Before, you just have to pick a method and stick with it for 5 years, and then you could change it. Okay. If you were an inventory-based business, no matter how much revenue you did, you had to be filed on an accrual basis. And that's not really the best way for businesses to file, especially small businesses where cash flow is key, because if you make an agreement with somebody and you agree upon the price and you provide services, you're supposed to count the income whether you got that money from them or not. Right? So you had to report, you had to claim income that you hadn't even gotten yet. And then guess what? If you didn't get it, then we had to account for it the next year as bad debt. So it just got a little complicated. But now they've raised it. Anybody whose revenue is less than $26 million per year, which I know 6 or 7 of you are over that, but if you make less than $26 million a year, you can choose your method from year to year, which is nice. That's a great flexibility. All right? All right, let's talk about some general tax law changes. So I mentioned the W-4 changes. This is because these withholdings have been so screwed up in the past, okay? So now they came out with a new W-4. We will probably have to help you with it because it is a very, I mean, they give you step-by-step instructions, but you have to take into account whether they itemized their deductions or their deduction last year. Did they use if they itemized, how much was that? If for each kid, they have to do a calculation to get the amount of the withholding. So here's the bottom line. Any new employees hired after January 1 have to fill out the new W-4. Previous employees do not, unless they want to change their method of withholding. If they want to change their method of hold, like how much they withhold, or now they're single, they were married before, and they want to change it, they have to use the new form. Okay? So if you need any help with that, let us know. When you we'll send out the new W-4 for those of you that are doing, I know we do payroll for most of you, so send it out to us. Okay, how many people pay people by salary? Okay, all right. You're gonna have to be really, really careful. I'll tell you why in a second. Okay, so the salary rule was called the high earners wage rule. Okay, $455 a week if you paid them said that you did not have to pay them overtime. Now, I know $455 doesn't seem like high earners wages, but when you think about that, $455 goes all the way back to 1972. And in 72, $455 a week was pretty good because you could buy a brand new car for $2,000, right? So that was considered high earners wages at that time. It had never been changed. Now, not everybody qualifies for this. I've had to tell some clients that when I bring them on that have restaurants, you can't just pay a cook $455 because you don't want to pay them overtime. They're supposed to be a manager, supervisor, upper echelon person, okay? So the Obama administration tried to raise it to $980, saying that's more like a high earner today, $1,000 a week roughly. The Republicans said, no way, we're not going to let that happen. So it got killed, but it's been being fought for what now, more than 3 years he's been out of office. So they've been fighting this thing for 3 years. And remember, Republicans wanted $455, Democrats wanted $980, right about in the middle. So they compromised again and said, okay, we will make that number $684 a week. So now you must pay your employees $684 a week if they're on salary. Otherwise, you're going to have to pay them overtime. Okay? Now, a couple of things about that. Again, they got to be a supervisor, a manager for you to justify this. Anybody else, you're going to have to pay overtime to. Also, this number still has to comply with the minimum wage law. So they still have to make at least $7.25 an hour. So what that means is if you have an employee that's on salary of $684 a week and they're working more than 90 hours a week, you are not paying them $7.25 an hour. So you have to boost their pay to cover that. Now granted, I mean, most of your salary people aren't working 90 hours a week, unless you're in the car business or something like that. But just keep that in mind, right? Okay. Cody, I said yours is confusing because you have what's called a white collar exemption, which is for computer programmers.
Okay.
So guess what your rule says?
Get it out.
It has moved from $100,000 minimum salary to avoid overtime to $107,000.
Okay.
So we need to look at how you're paying your people, and we need to look at the time they're working and determine should we change them to an hourly wage or what.
Okay.
Okay? All right, this one's interesting. So I can't believe the state passed it, to tell you the truth, because we're so, so conservative. But, up until now, in order to be determined to be not discriminated against, there was the categories only included what they called immutable characteristics, meaning things you couldn't change. Your race, your sex, your age, right? Your gender. Is that sex?
It says sex. And I made a note, and now
My
I'm signing
sister
it.
said I have to say gender instead of sex. Okay. I don't know why. I guess I'll listen to her.
New law, yeah.
Yeah, it must be a new PC law I missed or something. Okay, gender, those things that you couldn't change. But both the federal government and the state of Louisiana recently passed laws to protect gay and transgender people as well, under all of those federal and state statutes against discrimination. So you need to be, I'm just telling you because you need to be careful, obviously, all the time. I mean, but they are now included in the law, and there's a lot of precedence in that law. So in other words, when I say there's a lot of precedence, I mean owners of companies lose a lot. Okay, so just, make sure you're aware of this. All right, unlawful cellular tracking devices. People are like, really? I've got construction workers that require their employees to let them track their iPhones to make sure that they're in the right place at the right time and stuff like that. You can no longer do that. Mrs. McGee. Now, if it's a company-owned vehicle, you can GPS the vehicle. You cannot GPS the people, but you can GPS the vehicle. And our private investigator over there is going, whoa, wow. Well, they made it illegal a couple of years ago for private investigators to GPS stuff, cars and stuff. So this is kind of a continuation on that. So you cannot do that anymore. The other thing that you cannot do is use any sort of listening device or recording device unless at least one person knows the conversation is being recorded. Now that's always been, Louisiana's always been a one-party state, meaning one person needs to know it's recording. So we could be having this conversation right now, Gabe could be secretly recording it, and it would be completely legal in court because he knows it's being taped. Recorded, I'm sorry, I'm old. Recorded as opposed to taped. But what can't happen is Rochelle can't sit there and hit record on something and leave the room and go in there and work and record us if none of us know that it's going on. Right? Okay.
So as long as one person knows.
As long as one person knows it's completely legal, the other people do not need to know. So, you hear all of those things.
Even if you're the one that's recording.
Now, why do they have that recording online if it's one party? Why do they have the recording that says this call may be recorded or monitored? Well, because they don't know what state somebody's calling from.
Okay.
So some states are two-party states, meaning both people have to know.
Gotcha.
Okay, so if you're tracking, like if you're listening or you're recording your calls on your office phones or whatever, you need to make sure that your employees are aware that it is being recorded. Okay. On another note, thinking about recording, this actually goes back, but it's still applicable. If you have cameras in your businesses, like video cameras, recording devices like that, you do not need to let anyone know if there's no sound. You can have hidden cameras all over the place. But if you add video and sound together, you are violating the Megan law, which is an eavesdropping rule or an eavesdropping law. So you have to let anyone and everyone know that they are being videotaped and sound. And I say that because one of my restaurants that I deal with, the owner's older, and he really needs to retire because his kids and his grandkids are all involved in the businesses, but he wants to be involved. So he goes into his office at their headquarters and he pulls up the cameras and he pretty much just watches and listens to the cameras all day long. And he has them over the register so you can see the customers and you can see the people and they're talking and they're listening. And I didn't know it. I saw the camera there, but I thought it was just, a vision camera to see what was going on. But when I went in his office, I heard the sound. I was like, oh wait, you need to put up signs. So now they have a sign that says, you are being, we have both audio and video surveillance. Because you have to, people have an expectation of privacy, and if you're gonna violate that privacy, you have to let them know. Okay?
Question,
Yes.
is the sign sufficient?
Is the sign? Yes, the sign, as long as the sign is up where people can see it. Now, you can't have it in your business and have it in the back room for your employees to see if your customers are gonna be recorded as well. Right?
Right.
So, I couldn't put it in your office if I'm bringing people in my office and I have recording in my office. I need to have it on the front door or in the hallway or somewhere where they can see it to know. Okay? Okay. How many of you have 1099 people? How many of you have W-2 people? Right? Okay. All right. So let's talk about this real quick. This is not a change, but there is more bite that they put into this. In other words, more enforcement. The state of Louisiana arrested 3 owners last year for intentionally counting people as contract labor when they should have been employees. Okay? So there's a list of 20 questions I'll send out with this slide presentation that makes you ask some questions. And any one answer does not necessarily rule you one way or the other. It's a preponderance of the rules. And what they boil down to is control. So, the questions you ask yourself, and it has nothing to do with how many hours a week they work, if they work sometimes and not sometimes. Do you find the jobs for them? Do you tell them how to do what they're doing? Do you provide a workspace for them? Do you provide tools for them? Do you make them work a particular schedule? Do they work predominantly for you? Is it a long-term, ongoing relationship? All of these things make you actually have an employee, not a 1099 person. Now, I'm going to pick on ESP for a second. I know that they have 1099 people, and I know that they get the employees, they get the customers, the clients, I should say, right? The clients for their people who meet with them. But the people that are paying 1099, they meet with them, they schedule to meet with the person, they are educated on how to do it. ESP does not tell them step by step, do this, do that, do the other thing. They don't train them. They might have staff meetings or something, but these people had some sort of training or license before they start, right? Your people in your company are probably similar?
Yeah.
What do
They have licenses and then we have employees as well.
Right. So see, they get the jobs for the people, but there's nothing that says that your 1099 people can't go out and solicit go work for other businesses or do stuff on their own or have their own company, as opposed to somebody that you're saying works exclusively for you.
You said,
right?
What if you're providing them a workspace?
Yeah, but workspace is one of those rare things too, because for instance, First Financial is the true definition of who was designed to be a contract labor person for you, a 1099 person. We do your monthly accounting, we do your payroll, we do your taxes. You come to us and say, we want you to do our taxes, but you don't tell us how to do them, you don't teach us how to do taxes, you don't train us, all of that stuff. But in some cases, we have employees, well, here's a prime example, Accurate Medical Billing, we go to her office and do the QuickBooks work and the accounting stuff at her office. She provides a space for us, a desk and a computer for us to do it. But again, it's the predominant stuff. I have other clients elsewhere. She doesn't tell me how to do the job. None of that stuff, okay? So, like the workplace is one of those smaller things. But again, the more things you say yes to on the form, the more chances are you have an employee versus a W-2 person. So, why would you not want to do that? Or why would you want to do that? So here's the point. If you have this person on payroll, it's going to cost the company roughly 10% of the payroll amount in taxes. Because you pay half of their FICA, which is 6.2, you pay half of their Medicaid, which is 1.45. You then also pay FUTA, which is federal unemployment, and SUTA, which is state unemployment. Right? So you have these costs associated with it. Now, let's tell you what the costs are if you classify them as a contract laborer and you get caught. Because the IRS is going to come in, they're going to look, they're going to apply that test that I'm going to email you to you. And if they determine that you got 1099 people, they're going to reclassify all your 1099 labor as W-2.
Wow.
and charge you the taxes. So
Retroactive.
you are, yes,
With
retroactively,
penalty.
and they can go back 3 years. So watch this. You have to pay 15.3% of what, now even though you would have only paid half of it, you have to pay the entire self-employment tax. So you have to pay 15.3% on whatever monies you paid out in 1099. You have to pay whatever, so when the person filed a tax return, whatever their tax return was on their personal side for that year, you have to pay that rate as well. So if they were a 22% tax bracket person, you have to also pay 22% on top of the 15.3. Now we're up to 37%. On top of that, you have to pay 1.25% per month in interest for every month back to the date that you misclassified, which they can go back 3 years. You could be paying an additional 40%. Then you also have to pay 4.25% per month in penalties for up to 1 year. So that's about another 50%. So you could be paying 120, 130% on this 10% that you save. So what does that mean? Some people will still say, yeah, I'm still gonna break the law and take a chance, right? But if you get caught anytime over the next 13 years, it wasn't worth you doing. And that's if they decide not to put you in jail.
One more question. On that, the loophole would probably be that they would have their own tax ID.
So,
I was
okay.
gonna ask that.
All right, so that's generally been a misconception, okay? The problem is that was a loophole and people were kind of getting away with it. But a loophole can't intentionally violate the law. So if they determine that you just told your people to get an LLC with a tax ID number, but you're still treating them like an employee, it's not going to save you. Now, it will make it not stand out as much to them because it's not an individual getting a 1099, but they've gotten very hip to that. So there's a difference between loopholes and things people, and workarounds. Workarounds are workarounds around the law, which are still illegal. Loopholes are things that they just have not closed, so you're welcome to jump through them as long as they're open. Okay? So just be very careful with trying to, you all know I'm a straight arrow. I'm gonna jump through every loophole I can find for you, and until they close it, we're gonna keep using them because they're not illegal. But when you tell me, what do you tell me? If you tell me you took in cash, how should you handle it? What do I tell you? Put it in a bank. It's not worth it. It's not worth the legal issue. You really don't save that much in taxes on it. It still probably affects you down the line. When you want to buy a house or a car or whatever, and you've not put your cash into the bank and reported it, guess what? You lost, right? So just try to do things the right way.
Did you say 1099 employees can work exclusively for you and it's not a violation?
Okay, so first let's not call them 1099 employees. Let's call them 1099 laborers. Because we don't want to imply they're employees.
Yes,
But no, you could literally have a 1099 person that only works for you.
Okay.
But the bottom line is they could do something for someone else if they wanted to.
Okay.
Like my sister up north, she gets a 1099 from a dance studio, and she keeps their books and stuff, and she keeps them on site and all that stuff. But they're the only one she works for, and it's like a full-time thing. But guess what? If she wants to, she can go hold herself out to other people to do that kind of work. So, and they don't tell her how to do it. They don't give her a schedule. They can't just fire her. Technically, you can't fire a consultant or somebody. You can stop doing business with them, but you're not firing them per se. Even though I know people say you're fired, but you're really not. Not like an employee. Okay? Alrighty. Okay. Yeah, I should have corrected this. It's actually Fair Labor Standards Act instead of FLSA. But as everyone, I'll tell you later, I am a procrastinator. I don't prepare for speeches. I don't, do that kind of thing. So I put this together Sunday night before the Monday thing. Fair Labor Standards Act. Okay. The Fair Labor Standards Act says you have to give unlimited breaks for breastfeeding to moms for the first year now. That's brand new for this year. Now that's if you have 50 employees. But keep in mind that if you have multiple locations within 75 miles of each other, that you're considered to have 50, they combine those. So like I had people that have 4 restaurants, and each restaurant only has about 20 people in it, but they're within 75 miles, 80 people. They've got to start abiding by a lot more rules. If you ever get above 50, this is just the one for this year. If you ever get to be above 50, you need to tell me, hey, I'm now above 50, so we can start talking about every law that applies to you now that you have more than 50 people. Because one of the mandates that didn't go away is that people with over 50 employees have to provide have healthcare available for their employees. That was part of Obamacare. It's still in effect. They're trying to overturn it now, but they haven't had much luck with it. Okay, Family Medical Leave Act. So the Family Medical Leave Act says that in certain situations, you will give your employees unpaid leave. Now, there's a caveat nobody likes, but there's a really easy way out of it. It technically says you have to hold their job for them. Okay? But the way you get out of it is very simple. It says, unless it's going to cause undue burden on the company. And they can't really judge that, but so you have some choices. You can hire somebody and tell them, hey, this is a temporary job. If they want to come back, I have to technically offer them their job back. If they don't want it, you can stay in the job, or if they want it and we can move you somewhere else, we'll do that, or whatever you want to do. Or you can just claim right away that it's going to put an undue burden on the company and not do it, okay? But it says you have to give 12 weeks unpaid, here's your PC, childbirth and bonding leave. It used to just say childbirth, and people would, I guess, argue, well, I mean, you go back to work in 2-3 weeks after you have a child. Some people do. So they added and bonding to it.
And husbands can bond as well, so that's probably.
Well, husbands aren't covered by this 12 weeks of unpaid childbirth rule. You can give it to them, but now if you work for Google, husbands get 6 months paid leave, after paternity leave. Was that post office has some
Hey,
too?
Randy.
Okay. So now pay equity. This applies to mostly everybody that hires somebody. So be careful with this. And if you have a application, you need to change your application, because you may no longer ask them how much they are currently making or previously made on their jobs. Now, if they volunteer the information, that's completely different. But you cannot come out and say, how much were you making at that job? Whether it's hourly, salary, whatever, you can't ask them that anymore. I guess the reason behind it is it prejudices how much you're going to pay them. So they lie about it anyway, so it doesn't really matter. All right, you must have a sexual harassment policy. This was always suggested. Now it was made a law that says you have to have a sexual harassment policy in your handbook. So what does that mean? What does that imply? Anybody?
You have a handbook?
That you have a handbook. How many of you have a written handbook? It should be about 30 pages long if you have a real handbook. I know you guys do because you need it for licensing. You guys look at the handbook.
I don't.
Okay. All right. If you don't really need it if you don't have W-2 employees, but if you work pretty regularly with 1099 people, I recommend that you have one as well, although you're not required to have one in that instance. But that handbook is going to tell you the company's background, contact information, who runs the company. It's going to tell you the company's policies on vacation and benefits. It's going to tell you, the email policy and all of these different things, okay? When I asked most people, I remember when I was out consulting and I'd ask them, do you have a handbook? Well, no, I'm working on it. How long have you been working on it? Oh, well, about a year. Well, first of all, when you get done at this, is it really going to comply with everything? I doubt, but so easy workaround. Sorry, this will be the only sales pitch of it. Maybe there'll be one other sales pitch, but probably the only sales pitch, which is that First Financial writes a handbook for $350. So and we can do it in a day, and it'll be done, and you'll be compliant, and you don't have to worry. Cause
You can do it in
let's
a
go.
day?
Yeah. So let's go. Let's do a little quiz. I want to know how much the average lawsuit was, and if your previous client, you know this answer, it's still going to be wrong because it changed, but how much the average settlement was in the sexual harassment lawsuits in 2019? 120 grand. That's a lot, huh? Just a throw a number.
200?
200.
I'm going way up.
Okay.
I'm going 1.5 million.
Okay.
50,000.
75.
60.
Who's not spent?
I say about
Politicians.
2.5 million.
I'm saying 100.
Okay. So the number is $313,501.
Gonna say 300,000.
So, what would that do to your business if you got a
Oh,
fine?
my
Now,
God.
now, granted, keep in mind, that is all sexual harassment lawsuits. So, there's probably some real big ones from some companies and probably some smaller ones. But the bottom line is, you're not gonna get a sexual harassment lawsuit less than probably $25,000 settlement, okay? So, you need to keep that in mind and make sure that you have a handbook, because a $350 handbook can avoid you from having that lawsuit. Now granted, if there's a blatant case of it, but the sexual harassment policy will lay out what the company's policy is on it. It gives them options on how to handle if, employees, if they have a complaint or a problem, of working up the chain. Most of my clients put the stipulation in there that if the problem is with the owner themselves, that they are welcome to contact First Financial, and we will help them, work through a mediation kind of deal to do. So, gotta have the policy in there. Also now this year, another reason you gotta have one, and we're gonna update yours for you, Angelique, because we did yours, but now we have to have an Americans with Disability Act policy in your handbook, okay? So typically what we do is we write the handbook the first time, and then each year as things change, we will update it. If it's a minor change, like 1 or 2 things that need to be added, we don't charge anything. It's gonna take a little bit longer. We charge like a $20 administration fee each year to change stuff. But that's if you wanna change stuff. We change all the law stuff at no charge, okay? But if you come back and say, oh, well, now I wanna change how I do vacations and this and that, then that's a little different story, okay?
Sexual harassment, like universal?
No.
What could you change in there? In favor of it?
No, you wouldn't change anything with regard to the sexual harassment policy.
Right, so it's just a generic
Uh,
across the board for everybody, right?
no, there's a generic thought process behind it, but there's not a standard written one anywhere. You have to basically, again, define what you call sexual or what you determine is sexual harassment, give them the ability to, fill out a form of some type to file a complaint, to go to the person above them if they're
Some procedurally.
procedures all the way up, because what you're trying to do is you're really trying to curb this thing before it gets to the actual court case, because I tell clients all the time, doesn't matter if you're right or wrong, if you gotta go to court, you lost, because you are paying attorney fees and everything else along the way, so just try to avoid it, okay? Okay, NLRB is National Labor Relations Board. There's a new test for balancing employees. Some of the older people in here, I'm over 50, will remember this, but it is now illegal. You may not ban your employees from talking to each other about how much they make or the benefits that they're receiving. And that was a very common practice in the past. In fact, people would get fired for it. They make you sign things and write things that said, I will not discuss my pay or my benefits with other employees. You can't do that anymore. The law makes sense.
Even 1099?
What's that?
Even 1099?
Nobody. You cannot ban anybody from telling anybody else what you make. Okay? All right. Let's talk about these I-9s here. So, who has employees that, well, everybody that's here has employees that are my clients, so you all are in compliance.
Okay.
You guys have employees, right? Okay.
Single you out.
Let me get you. So, do you guys fill out an I-9 form for each employee? That's the one you get the driver's license and social security card or something that says they can work in the United States?
Yes.
Okay, good. And then, do you keep individual folders, like employee folders where you have their application, their I-9s? Now, I know your medical stuff's probably in a separate one because
Right.
you guys are good about that kind of compliance. Okay, and you have their I-9s, their driver's license, just all that stuff. Each person has a file, right? Okay, good. And then how about a filing cabinet? Is something, we're in a filing cabinet?
They are.
Okay, does that filing cabinet have a lock on it, even if it's not locked all the time? Good. And does the door to the room that they're in lock?
Yes,
Okay, good. So how many employees do you have?
right now we have 7.
Okay.
What? We can't do that.
Huh? You got 7? Okay. Here you go. I am from Immigration and Customs Enforcement. Here's
Lock me up.
Here's a bill for $10,500 that needs to be remitted within 14 days.
Why?
Okay. If you don't get it to
Change
us,
it
if you don't get it to us, we're gonna be back in 30 days to check. And if it's not right, that's gonna go from $1,500 a person to $11,000 a person, and we can put you in jail for up to 2 years.
What the
Okay,
hell?
so let me
Okay.
explain what just happened here.
Please do.
So in 2008, prior to 2008, Immigration and Naturalization, well, that's what they were called then, they weren't called ICE, would go into a job site and they want to see your, I do an I-9 audit. And they ask to see your I-9s. Well, that was okay in a smaller company like 7, where you had them in individual folders. But if you had 100 employees, they'd have to sit there with their list of employees and they'd have to pull out each folder, find the I-9, find the driver's license, find the social. Okay? And then they'd mark it off and then they'd put it back. So they went in about 25,000 businesses a year. So 2008, they said, okay, we're gonna change this rule, we're gonna change this law. You now have to keep your I-9s and their supporting documentation stapled together, and they need to be in one I-9 folder for your current employees and all your employees back 3 years. They need to be alphabetized. Now, if you're our clients, we're automated. So each one of you has a folder in our computer that says I-9s, and then all your employees are listed alphabetically and their forms are in each one. So if INS shows up or ICE shows up at your location, you tell them it's at your accountant's office, and they'll have to come over here and we will let them have access to that, okay? Now, here's the interesting thing. When you do this, if you're doing paper, you might violate the rule of how long you have to keep these things. So you have to keep them 1 year past the employee's date if they've been there for more than 2 years, or you have to keep them for 3 years beyond when they leave. So it's one of those catch-22s. Now here, I can finally use this example because I don't have any employee turnover. So Rochelle is our newest person. She didn't replace somebody, she came because we needed more help. So for all of my other employees, they've all been here for 5 years or more. So when they leave, I just have to keep their I-9s for 1 year. But Rochelle came to us in September. So if she leaves tomorrow, we have to keep her I-9 documentation for 3 years, for a total of 3 years. So we gotta keep like another 2.5 years, okay? If you guys do this stuff in a computer format, in a folder, they can stay in there forever, right? So you don't ever have to worry about getting rid of them, being out of compliance,
You can come to
okay?
our office.
Mm-hmm. So now, if you don't believe me, I'm going to show you 2 things. Everybody heard of Abercrombie and Fitch?
Yeah.
Wait. Well, there we go. What's that say?
$1 million mistake.
$1 million mistake that Abercrombie and Fitch made. Now, 2 things about that. That was a negotiated down penalty, because this was in 2010, so they made an argument, we didn't know the law changed, whatever. So they allowed them to negotiate it down to $1 million, and this was only for their Michigan locations. Okay? So, obviously, what I'm telling you is that it's really, really important. Now, because they made $1.2 billion last year in I-9 audits, the White House said, well, guess what? If we have ICE doing it, we made $1.2 billion. He did sign an executive order to task the Department of Homeland Security and Department of Labor to join ICE in audits. In other words, the thinking is they'll be able to triple the amount of fines that they'll be able to collect. Okay? So now you have 3 agencies that are going to be coming around doing it. We are in the corridor, you know, that corridor from like Southern California over to Florida below a certain amount because of the amount of illegal labor we have. Okay? So Don't not expect it. We had 2 clients last year that got audited.
Wow.
That's the W4 employees on.
I-9s. So yes, W4 are actual employees, W2 employees.
Digital copies, fine with all that?
Digital copy is fine. That's why I said, look, if you're not using Dropbox or some other system at this point, you're just behind Google Drive or something that's online, because we have all our stuff to the on a server, but it backs up to our cloud, because what if we have a fire?
Right.
Everything's gone, right? So you're not going to have. What happens if you have a fire now, and then in a year, IMS or ICE comes in to do the audit? You don't have your people's paperwork from the previous years. So, and it just depends on who you get, whether they'll be nice about it. Okay? All right. This one has not affected Louisiana yet. 21 states enacted new minimum wage laws last year that said $7.25 an hour is not enough, and they raised their own state minimum wage to above the federal level. Okay? I think Louisiana is probably one of those states where the politicians are in people's pockets enough that they would not raise it like these other states did against the federal government's wage rate. But the problem is, the more states that do it, at some point the pressure is going to be on the federal government to say, look, 38 of your 50 states feel like the minimum wage is not enough. We need to raise it everywhere. Okay? So I think that's probably coming in the next 2 years. All right. Payments made in sexual harassment cases are not subject, they're not deductible if you do a non-disclosure agreement with the person. If you tell a person they cannot disclose how much money you settled their case for with them, then you cannot deduct it as an expense to your business either. That's going to affect a lot of big businesses.
To clarify the sexual harassment cases, between employees, the business is still beholden to paying no matter what
It can be.
Okay.
Now, not necessarily. If you've got a good sexual harassment policy in your book that states, what's expected, but if you have a culture where you allow things to happen, and look, by the way, when you get your handbook, you need to follow your handbook. If it says people are going to get written up for being late, they need to be written up for coming in late. If it says they're going to be fired under certain offenses, you need to fire them. I don't care who it is. I don't care if it's their supposed best employee. You need to follow your handbook. Because what happens is, if you have the handbook and then you treat somebody differently, and they say, well, such and such did the same thing and they didn't get fired, right? So if you have a good sexual harassment policy, you follow that sexual harassment policy, it's rare that the business is held liable especially when it's between 2 employees. It's kind of rare that they are even held liable even when the company is at fault, because the people didn't do what they were supposed to do in the handbook to justify it. So, okay? All right, and I keep on going, so if y'all want to use the restroom or something, or you need a break, let me know. All right, let me give y'all some tax tips. So some of these are loopholes, some of them are regular old things, okay? So this first one is a loophole, big old loophole. I don't know if they'll ever change it, because politicians do this kind of stuff all the time, so they'll probably never change it. Your company and you are 2 different people. And I said people because you're 2 different, whether it's entity or whatever, but the IRS considers you 2 different people. Now, when you own or rent a house or an apartment or whatever, wherever you live. Now, the only exception is that you cannot have your office at home. It can't be a home office, so we need to talk about that. What you can do, and it's completely legal, is the company can rent out your house from you to hold staff meetings or client meetings or whatever you want to do business wise, and the company gets to deduct the expense, and you as an individual do not have to claim the income as rental income, provided a couple of things happen. You can do it up to 14 days a year. You're allowed to rent your house and not claim it as income. Did you real estate people know that?
No.
Okay. So that's fine. That's fine. Okay. So anybody can do it. Okay. Now, you need to make sure 2 things happen. It has to be a legitimate business thing. You can't just say, oh, I held a meeting at my house. So what I recommend, in case you'd ever get audited, and again, I wouldn't really worry about that with us too much, but in case you get audited, you really should have something that says, we met at the house, you know, these are people that came and this is what we talked about, okay? And two, it has to be a reasonable amount. So you can't hold a staff meeting of, you know, even 10 people at your house for the day and charge $5,000 rent to your company, right? It has to be what you could reasonably rent something else for, so, you know, but how much would a room cost all day at Holiday Inn? It would cost $1,000 or so. So you could pay, the company can write off $14,000 a year and not pay taxes on it, pay it to you individually, and you do not have to pay taxes on it. Nice, right?
You don't have to claim it?
No, you do not have to claim it on your personal return. No, absolutely not. That's what I'm telling you. It is not income to you as an individual. And your company gets the tax write-off, which then translates to you personally, so you get the tax write-off. Nice, huh? All right. Next one. This one's been there forever. They're never gonna change this one. Because again, the rich people do it, right? Hire your children. Why would you do that? Okay? First of all, if they have to pay any taxes, they're gonna be at a lower tax bracket than you are. Right? So if you're a 28% tax bracket person, and even if the child has to pay taxes on it, they're probably gonna be in the 12% tax bracket. So you deduct it from the business as an expense, which saves you 28%, and then you pay 12% taxes on it, so you net 16% better in taxes, right? But what did the government do to help this? They changed the tax law, right? So they raised now the standard deduction to $12,400. So now what does that mean? Your child does not pay taxes on the first $12,400 that you pay them. So now you're not paying 28% on it, you are paying 12%. I mean, 0 because you're paying less than 12.
So
Yes.
all of this is in place for Walker? Or
Yes.
is it because he's older than 18?
No,
Does
it,
count?
no, it doesn't,
And when did that start?
so this law goes back 30 years.
And so you've been doing this for,
Well, you've been getting de facto because we've been paying Walker W-2, which reduces how much money your company makes, and we've been filing his tax return.
so
And
this
he's
is
not been
happening
paying taxes,
anyway.
right? Because how much is his withholding for federal taxes? 0.
You do it, I don't
Right,
know.
0. He doesn't withhold anything from his, well, he doesn't hold out any federal taxes from his paycheck because he doesn't owe any, because he makes less than $12,000 a year. So instead of withholding and giving them money back, why would you do that? Just
Why?
let them withhold. Okay? So, so that's good. Now, on top of that, if you have a sole proprietorship, which is a Schedule C person, if you're a Schedule C person, your child that's under the age of 18 does not have to have FICA and Medicare withheld or paid in by you or the company. Okay? Now, some of you are going, man, you changed it to an S Corp. Man, I can't do that. I didn't change it to an S Corp. I changed your taxation to an S Corp. But that's true. So, how many of you own more than one company? Okay? If you don't own more than one company, open one more. Spend $100 to open one that we will file as a Schedule C, and it will be the management company for your S corporation. You will pay the management company $1,000 a month, which deducts it from your S corp taxes, and then on that management company, you will pay your child out of that management company. And then guess what? It's a Schedule C, it's a sole proprietorship, you do not have to pay taxes. That's not a workaround, it's a loophole. Maybe at some point they'd close that, but guess what? It's not gonna benefit the politicians, so they're not gonna do it. Okay? So that's the workaround. Now, your only rules with this that you cannot, that is a workaround or a violation of the law, is your child has to be performing a service for you. You can't just, because you got 3 kids, put them on payroll.
So you don't have to pay it in
Right?
lines.
They have to be doing some kind of work, which is why you don't have a problem. Walker does work, right? Okay. And then the second thing is you have to be paying them a reasonable amount for what they're doing. Okay? So my granddaughter comes up here. She's 5, right, Rochelle? She comes, hangs out with everybody. But if she wants to shred $1 an hour to shred some papers, right? But I couldn't pay her $25 an hour, right? That wouldn't be reasonable, okay? So you have to keep those two things in mind, okay? Alrighty, let's talk about car expense. So car expenses, everybody knows we can deduct car expenses, right? It doesn't matter whether the car's in your name or the company name. Now, there are some caveats with that. If you have an S Corp, it's technically supposed to be in the company name. So we need to look at, if it's in your personal name, we're going to add a mileage reimbursement onto your check for it, and there's no limitation for that. We can add that mileage onto your check to pay you for it. It's not taxable, okay? But you're gonna have the company pay you mileage, which gives the company the deduction. You're gonna pay it to yourself personally, and you're gonna pay your car note and stuff out of your personal taxes. So it's a way the company can pay it, but it's just like a little technical aspect we have to do, and that's completely all right too, okay? But let's just talk generically.
So, is it a mileage allowance, like up to, or you have to actually track the amount of miles?
Okay, so, here we go. There are two ways to deduct auto expense. One is called the actual method, one is called the standard mileage method.
No, I'm talking about if you pay on if the company pays you an allowance.
So,
Okay.
actual method, standard method, okay? But here's the thing. Every method that you use, whether you're reimbursing yourself, whether you are doing the actual method, standard method, you are required to keep a log. But let's talk about that, okay? Now, if your allowance, let's say you got a $750 car note that you're trying to cover the expense of, you can do a mileage reimbursement on your check, and you can also do a car allowance reimbursement, which is not taxable either. So you can make it work whether it complies with your mileage or not. You with me on that? Okay. All right. Let's talk about how this happens. You have, on the actual method, you drive 20,000 miles for the year. 10,000 of those miles are business. Now, what justifies business? Any trip from your home anywhere, unless you have a home office, is not considered business miles. It's considered commuting miles. Okay? So if you go from your house, and okay, let me use a better example. We have a client that lives in Breaux Bridge, and she drives to Baton Rouge to work every day. That is to her office here. That is commuting miles. Okay? So what did I tell her to do? She's got like 6 rental properties in Breaux Bridge. I told her, drive from your house to your rental property and check on it. Do a drive-by. Now that's your commuting miles. Now from your source of revenue to your other source of revenue in Baton Rouge, now that's business miles. So what I'm saying is, if you don't have a home office and you're driving relatively far to work, find a business reason to stop along the way. And again, legal.
Okay, so I pick up things from my clients. I leave my house, and I go to my clients, and I pick up their documents for the week.
Commuting miles.
And then I go from there to my office. I should
Commuting
be writing
miles.
those?
No, those are commuting miles.
Why?
Now, well, from
Why?
home to your client's office is commuting miles. From their office to your office is now business miles.
Okay.
But since you live so close to your office, like less than a mile,
And
you
my
need to be
client's
driving
1 mile.
to your office. Yeah, but you're still gonna pick up because you're gonna drive to your office, which is right there around the corner, and then leave your office and go to your clients. Now, that's commuting miles from your home to your office. But now you've picked up business miles from your office to the client, and then back from your client back to your office. For you, it's really a simple choice because it's so close. Just stop at your office. You don't need to go in, stop at your office.
Gotcha.
Okay? You're checking to see if the lights are left on all night, check the mail, whatever, then go pick stuff up. Okay? So,
I'm sorry, go ahead.
no, go ahead, because I want to make sure you don't forget the questions, but it's probably
Well, this
some.
is a question for myself. As you know, I did delivery. So I had the business that was claiming the mileage, okay? And on the other side of it, on personal, I owned a car, but I was renting it to the company. But I couldn't claim the rent,
You can only claim what you are not reimbursed for. So in other words, like if you're gonna have the company pay you money and you're gonna get that taxable benefit there, you cannot also claim it personally.
that'd be one or the other.
It's gotta be one or the other.
Okay.
That's why when she asked the question about the mileage, is it a certain number of miles? Yes, technically it is, because anything you pay the person over the mileage reimbursement is taxable income. But that's why I said that's when you start doing a mileage reimbursement and a car allowance. Okay, so let me keep on going. So actual expenses, you drive 20,000 miles, 10,000 are have been determined to be business miles. You can now write off 50% of the depreciation on the car, 50% of your gas, insurance, repairs and maintenance, car washes, deductibles on insurance if you got into an accident, anything related to the expense of that car, you can now write off 50%. Okay? Conversely, if we do the standard miles, it just had the biggest jump in history. They took it from 54 cents to 58 cents per mile. Now, standard miles is almost always going to be more than the other way, because how many miles do you get out of a tank of gas? 400 miles, 300 miles, even if it's say 300 miles, right? 200 miles?
I get 12.9 miles.
Yeah, but you got a big tank too. You got about a 25,000 gallon. So anyway, let's go low. Let's go 200 miles out of a tank of gas, right? 200 miles out of a tank of gas. How much money do you spend on the gas?
About $2.
No, to fill up a tank.
Oh, about $50.
Okay, about $50. So she spent $50 to fill up the tank to go 200 miles. She would get $116 on the mileage reimbursement, the standard mileage reimbursement. And that's if and just because she drives a big expedition. I mean, most people don't get 10 miles to the gallon, right? So it's almost always going to be better to do the standard mileage. But the nice thing is we can pick and choose each year, okay? Now, let me tell you why you would want to do one over the other. So if you get audited, which they did say, the IRS, that they are going to start looking at car expenses, okay? Not to do a full audit, but what they call a paper audit. So they might send you a letter that says, we want you to justify your mileage or your car expenses, okay? You are going to need to provide to them a mileage log. Now the mileage log, and don't fret completely yet, the mileage log needs to show the date, the address you left, the address you went to, the starting miles, the ending miles, the total miles. Used to require the business purpose on them too, but they don't really do that anymore because it was just too hard to track, okay? So you have to have those things. You have to also have some sort of third-party corroboration of the miles, meaning like an oil change receipt from early in the years that shows how many miles were on the car towards the beginning of the year, and something towards the end of the year, maybe an inspection sticker, anything that can help them determine, yeah, that, you know, this doesn't go from January 1 to December 31, but it was about this many miles, so that makes sense, okay? You also, on the actual method, have to have all your receipts, gas receipts, insurance bills, repair bills, when they pass through your bank, everything, okay? Now, on the standard mileage one, you need to have the log and that at beginning and end of year stuff, and that's it. You don't need to provide any receipts for anything. So that already makes it easier. Now, what's going to make it even easier, and I'm sorry, my camera's filming, but I have an app. There are several probably, but I like this one. It's called Mile IQ. You leave it running all the time. It knows when you're in your car. You set your starting miles when you set up the app. You can put in there your home address. You can put in there your office address, okay? The more things like that, if you put those things in, it will help automate your life for you. Then every time you get in the car, it starts tracking the address you left, the address you stopped, okay? At the end of the day, I go in and I spend probably about 30 seconds, and it shows the trip. It shows the starting and the ending, and you swipe what's the app, Tinder? You swipe left to say it's personal, and you swipe right to say it's business. So at the end of the day, I'll see it'll say home and office or whatever, and I'll just go do.
It is very easy.
And I'm done for the day.
My problem is
Yeah, I
remembering
do
to
it
do
every
it.
night.
Well, here's the thing, if you set it so it's automatically running, you don't have to start it every time you get in the car,
Right.
it
No,
just
I'm
does
talking
it.
about the swiping.
Well, that's
I
okay,
know.
guess what, even if you do it by a month, it's not
Yeah.
gonna take that long to swipe back and forth, especially when you see home and work. Now, the other thing that it does, which is really nice, is when it starts to recognize certain patterns,
Yeah.
it will you can click yes to auto, like it'll tell you, I noticed every time you leave home, it says that this is personal. Do you wanna auto classify? There are 32 transactions that meet this qualification. And you hit yes, and it will automatically start classifying those as home. It's really, really easy. It's really not like you think it is, because you can do it anywhere. You can be sitting watching TV and just swipe through them real quick, right? And there's no deadline. They stay in there, so you don't have to do them at the end of the day, okay?
And it's January, so it's a good time.
It's a really good time to do it. Now,
Like you.
for unlimited trips, unlimited usage, it's $59 a year. It's certainly gotta be easier than trying to remember to track, because don't forget, if you manually track your miles on a mileage log, you also have to track your personal trips as well. It's not just business trips you're documenting. The mileage has to be, continuous. So if there's a gap in there, the IRS is gonna disallow it. Okay? Alrighty.
And my
So-
business can pay that $59?
Oh, absolutely. Absolutely. Business expense. So now it's really not costing you 59. If you're at a 25% tax bracket, it's costing you 45, right? Okay, technical $44.66. Okay. Here's one. Now, don't do this if you have a $5,000 piece of equipment. You got a piece of equipment that's worth $100, $200 or something. Abandon it. Don't sell it. Here's why. When you abandon it, which means throw it away, leave it on the curb, take it somewhere, not donate, that's a technical term. Take it to an office and say, I don't want this thing anymore, and walk away from it. That's abandoning it, okay? Here's your difference. If you abandon the equipment, we get to count what's called an ordinary loss. That means we get to count, we get to assign a value to that equipment, which is often more than you can sell it for. If you're selling a $10-year-old computer, how much can you sell it for, Cody?
Depends on the computer, your hard drive, your
You
video
haven't
card.
changed anything. You bought this thing 10 years ago.
Roughly 25% if you're lucky. 10 years. Like
Yeah,
that's just
so if it were
hardware.
a $500 computer, you could sell it for $100.
If you're lucky.
If you're lucky. I don't know, I probably argue it might even be worse than that, right? But I get to say, you donated a Toshiba laptop, it does not ask me what processors it has in it, how much RAM, how much meg, and it'll give me a value of $500 for a 10-year-old laptop, because maybe this laptop, if it's 10 years old, this was a $3,000 laptop. So it's probably gonna be worth $500 at the end of the time, right? So it's a very generous number. So now I get to count a loss of $500 of ordinary income, which means 25% is what you get credit for on that. So you've got a $125 credit, okay? Now let's see what happens if you sell it. If you sell it for $100, you pick up $100, right? So you're already behind the 8 ball in this example because you're getting less. But at the same time, it's called it would be not a capital loss even because you got some money from it. It's a capital gain. So now you have to claim the 100%, the $100 in income as well. And if your capital gains rate is 20%, so now you have to pay $20 in taxes on it. So you really netted $80. And that's if you didn't have to advertise it somewhere or spend any time meeting with people, because time is money, right? So even if you put it for free on the marketplace and you got 2 people to come by and look at it, you gotta spend time with them. So really, did you make anything by selling it?
Can you abandon a vehicle?
Absolutely.
So I could abandon my vehicle at my nephew's house and get 25% because I just left it there and walked away?
Loophole. Well, it's not gonna be 25%, I mean, it's gonna be whatever the vehicle.
25% of whatever, okay.
If you
No, no,
abandon
no.
like laptop, for example,
Uh-huh.
how do you justify or how do you show that as?
Well, it should have been somewhere on your books that you bought it, so when you bought it as an expense, it'll be there.
How do you prove that you've abandoned it, though? Do you take a picture of
Your
it on
word.
the side of the road? Okay.
You can if you want to, but your word. Believe me, this is not something that will ever get audited. This is not, it's just not a big enough thing. I mean, you're only abandoning a few $100 piece of equipment. And it's just not enough to make a difference tax-wise if they'd ever even look at it. But if they do, it's your word. You say, I threw it away. I mean, it was worth nothing. I had a thing for 10 years.
Is there a cap on it?
No. No, but again, you don't wanna, you know, it's probably for something that's gonna be less than $500. You know, and something that you've had a long time.
Can you journal like something?
Sure, you could just put in a journal that you.
Journal it to your business. For example, if you had an old laptop, you weren't necessarily using it for the business 100% of the time. Can you transfer it to the business and then abandon it? If it's not on the books originally.
Yeah, but there are holding periods for things. So like capital losses have to be held, can't be taken unless you have the equipment for a year in the business. So what you're trying to do would not work unless you're really willing to donate it to the business or give it to the business, transfer it to the business, let the business use it for a year, and then you could do it. But no, you know, they have those things in place on purpose so that you can't skate too bad on it. Okay? Alrighty, so we should begin my IQ. Alright, and then abandoning equipment. Here's a way you can reduce your expenses. Reclassify some people as 1099, but again, I put be careful because we've already talked about that on whether you should or shouldn't, right? You know, 30 years ago when I first started, we used to have this tax book, and it wasn't very specific. It was kind of generic, but it would have like construction, and there'd be a construction section, and for every item, it would have like how much or what percent of the income every expense was or should be as an average. So here's how much you should be paying in contract labor. Here's the percentage of W-2 employees. Here's the percentage of office supplies. Here's how much in rent, right? And the IRS used to use that as a guide to take tax returns to determine who they were going to audit because they'd look and say, well, they're supposed to have this, they're supposed to have that. Unfortunately, one of the downfalls of technology is that stuff is all automated now. So there's a 6-digit code that goes on your tax return that determines what type of business you are. And it gets very specific because it's not just construction anymore. It's specific to plumbers and painters and whatever. Everybody has a different code. And now the computer just takes all these returns that are filed by all of the people in your same NAICS code, and it knows averages and how many things like that. So what happens is if you got everybody that's 1099, and your business, the average says that most people have no 1099 or they have some W-2, some 1099, the system now knows that, and that's where you start to get your audit triggers. So just be careful with this. I mean, you know, there's nothing wrong with having both 1099s and W-2s, but kind of be leery of whether you're really classifying them properly, okay? Okay, donate unused inventory. Anybody here carry inventory? Gabe, you have any inventory? Todd, do you have any inventory? You don't keep plants and stuff on hand? Okay, y'all pretty much know what you got. Okay, just so you know, if you have anything that's old that's sitting there that you would normally sell, you are better to donate it than to actually sell it. Okay, or throw it away, I should say, if anything. If you throw it away, you get to write off the cost of the item. If you donate it, you get to write off the retail value of the item. So, beneficial ways for you to
So
sell.
if I donate a vehicle, rather than abandoning this vehicle, I would be better off.
No,
Same, right?
no, because a vehicle is not considered inventory. So you can't write off the retail value.
Gotcha.
If you donate it, you'll be donating at the rate. That's okay, ask these questions. That's all right, ask these questions. This is how we figure this out.
I like the way you're thinking.
Okay, now this law has been in effect for several years, but it's gotten even better. So if you employ a veteran, a disabled person, or a disenfranchised person, which probably the easiest explanation for disenfranchised would be if somebody is on Medicaid or food stamps or something like that, some public assistance, even though they're working, they can still get that depending on how much they make and stuff like that. There is a work opportunity credit that is 25% of the salary you pay that person up to $6,000 per year.
Oh, so that's why they ask those questions when you fill out applications, like if you're disabled
Yes.
or.
Yes. Now, it's not just any disability. I technically am disabled because I have my disability card and my military card, whatever. But because I have a metal knee and a metal neck and whatever. But that doesn't qualify, believe it or not. It's certain disabilities, blindness, deafness, missing a limb. So there's certain qualifications for it, okay? So, but I mean, the veteran one is a big one. Ask your people if you have a veteran. Guess what I get to do? I've got escorts. I pay myself. I'm a veteran. I get a 25% discount on whatever I pay myself.
Do I get a discount for hiring you?
No, because we're 1099. You can hire me. You want to pay me
Just checking.
W-2? Pay me some W-2 income.
Just checking.
But how do you find out if someone is disenfranchised without?
I know, it's like.
All you can do
I
is
have
all you
somebody
can
that
do is
I
ask them.
know
And you know, you wouldn't want to
has food
embarrass them,
stamps,
but you would
But I don't
ask
wanna
them.
embarrass them, so I'm
Yeah.
not taking $6,000.
Yeah, I've seen the question where it asks like within so many years has your household received food stamps. It's like a list of
Right.
things.
Now, when they ask that, if it's within so many years, if they're not on them anymore, but you hire them and they were on it, you still get that credit for the first year. But if they're working for you and they're on it, you would get it the whole time. Yeah. You're providing a work opportunity for people that have typically not been able to have as good a chance of getting a job. So that's what the credit is for. I would ask them, you know,
I don't wanna jeopardize her getting her food stamp,
well, you're not jeopardizing that, you're paying that.
right? And I guess that
I
shows
mean,
up anyway.
well, what would
when
you be
she gets
jeopardizing?
Taxes taken out, so
Right.
they know
Right.
how much money she makes.
Right. You're not jeopardizing anything. Now, you could be embarrassing somebody. Go to each person individually and say, look, this is something that will give the company more money, which translates into
No,
your
they
job
don't do that.
security.
Yeah,
No,
you're helping me.
no, you gotta keep going with that.
Right,
Which will
okay.
translate into job security, and I'll be able to give better raises, or we'll be able to eat more, or whatever it is. You gotta give. See, look, when I was in the car business, some of you know I was in the car business for a lot of years. And I only sold for the first year, and then I moved into finance and stuff. But you have to tell people the benefit. Everybody loves car salespeople, right?
Yeah.
But I would go to a car and I would say, see this headlight? This headlight is a halogen headlight. If I stopped there, they wouldn't give a damn. But you know what I'd say? It burns twice as bright for visibility, it lasts twice as long, which means you replace it less. And when you do have to replace it, it's half as expensive as a regular light. And the people are like, yes. And the people are like, amazing, that's awesome. Well, guess what? When I was in the car business, every car had halogen headlights. But if I told them that and they saw the benefit, and the guy down the street that they just left didn't tell them that, they thought my car was better.
Right.
Right? He wasn't really lying, he was just pointing out the benefits. I showed them that my car was worth it, right? So when you're talking to your people, you have to still be a salesperson. And hopefully your people, look, let me tell you something. If your people don't even do it, you need to consider whether you have the right people. I'm gonna use an example. So when I started this company, it was just me, and a couple months into it, I realized I needed my clients. I wanted consulting, but my clients needed accounting. So I called Pam, who was a controller over at All Star, and I said, Pam, you wanna come work with me? Because we've been working together 7 years already. She was like, yeah, great. She came to work for me. So it's just us for a while. But then we got this contract to do this BP stuff. We basically put together financials for any businesses wanting to file BP for the court so that they could get a claim. Okay, so we had to hire all these people. Now, we knew they were going to be temporary, but a couple of them are still here because we kept a couple at the end of the thing. But they were working for me. And about 6 months into the project, all these new people, they came in the office, and Pam happened to be in there, we were sitting there talking, and there were 3 of them, and they said, well, we we changed the handbook. And I was like, in my head I was going, you did what? You changed my handbook? This is my company, my handbook. But cooler heads prevail. And I said, what do you mean you changed my handbook? And they said, well, we determined that there are too many paid holidays. You're paying us for days that aren't really holidays, so we took 4 of them out of the book. Now, when have you ever heard of employees doing that voluntarily? Those 3 people are still with us, okay? Because they should understand that the company is the company. I think Rochelle probably understands that pretty early here, that it's everybody's job and everybody's responsibility to cut the cost of the company. And if they just think that owners are greedy, they probably don't need to be with you anyway, because there's no loyalty, right? Anyway, that was just a side note. So anyway, so ask the people, just pull them to the side one by one and say, look, we just found out, or we found out that we can get a work credit for the company if, you know, you are on any kind of social assistance. Are you on any kind of social assistance? Or anybody in a direct family that lives with them, it could be on social thing. So it might be, the parent might not be, but the child might be on Medicaid. That would qualify for this work
So
opportunity.
as long as they're on Medicaid?
Yeah,
I know.
boom, there you go. That's something I would have asked you when I was doing your taxes.
So, when I read the work opportunity credit,
The federal one or the state work credit? You were reading the state one. Okay,
are you talking about federal?
this is federal.
So I shut it down because I did not inform them within 30 days
That's the
of
state.
the hiring.
That's the state.
So I was like, okay, well, I don't qualify because she's been here already for 38 days.
Right.
So, but I still put, is that part of the federal? Is there a time limit?
Nope. As long as they work for you anytime during the year.
I'm getting confirmation.
Now-
She's texting me.
Now, even if she's gotten off of it, you can still do it for this year as long as she was
Right.
on it at any point during during 2019, I mean.
Yes, she
So-
started in August of 2019.
No, but I'm saying if she was on, even if she got off of it when she got hired, you can still claim it for her income for 2019,
Okay.
okay? If she's still on it in 20, you can do
She
it for
is.
this year still. And she doesn't even, I mean, really, she doesn't even have to know about it at this point. You know she is, you can
I know
claim
she's
it.
Section
and
8
then-
because I had to fill out the paperwork for her rent.
People on Section 8, that's another, yeah,
Yeah, you good.
okay?
Yeah, I would claim.
All right, you all just will let me know. All right, credit for company paid childcare expenses, okay. I don't want this to come out the wrong way, but do not donate money just because you want a tax credit. Like, don't donate to a charity because you want a tax credit.
Right.
Donate to charity because you want to donate to charity and it has the nice benefit of you getting some tax credit. Do not spend money in your business on the idea that it's going to get you a tax credit. If you don't need a new vehicle, don't buy a new vehicle, right? So one of the new laws says that you can, company paid child care expenses for your employees are deductible 25%. Do it because you want to provide a service, help your employees, maybe maintain their loyalty, keep them working for you. Don't do it just because you're gonna get that 25% tax credit, because you're gonna spend $1,000 to get $250 in tax credit. And really, you aren't even getting $250 in tax credit. The company gets to deduct $250 worth of expenses, and then you're taxed at a 20% tax bracket, so you saved $50, but you paid $1,000, okay? So just keep that in mind as we move along, as you move along. All right, succession planning, because the rest is gonna go fairly quickly. Succession planning, exit strategies. I don't care whether you've been in business for 1 year, 10 years, 20 years, you need to already be thinking about how you're going to get out of that business. Whether you're gonna give it to your child, you wanna pass it on to a child, whether you wanna sell it. If you wanna sell it, by the way, she mentioned you need to get it valuated. I'm one of 2 valuation analysts in the state of Louisiana, so we do that as well. This was a section I said I was gonna have a little selling in. So we can, you know, you can do that, but you need to determine, is my plan to sell it? Because if my plan is to sell it, we need to do some tax planning, and tax planning doesn't need to be over the next 6 months. It needs to be long-term planning. Do we slowly replace equipment to build the value of the business? Do we slowly move away from certain types of other things that are drawing revenue and expense from the business? How, it's a planning thing. And so you really want to already think about what you want to do with the business, okay? And then that way you are moving on that path, moving on that plan that you set in motion, okay? Power of attorneys, how many people in here have a written power of attorney? Okay, 2 people. Okay. A power of attorney allows somebody to transact and handle your business for you if you are not available to do it. Available for any reason. You might be out of town on vacation and need somebody to go to the bank and do something for you. You might get into an accident and be in a coma in the hospital. Somebody's got to be able to call and see how much your bill is that's due, or those type of things. You have to have a power of attorney, especially as a business owner. Remember she talked about business continuity? I ask this question to my businesses, especially when I first meet them. If you didn't die, but you got into a car accident today, and you were in a coma and you couldn't speak to your business for 6 months, where would your business be when you got out? Most people will tell you it's dead. Or they'll say, Angelique might tell me, well, Eric knows how to run a business as well as me. And I look right back and say, y'all never ride in the car together? What if y'all both in the car together when it happens, right? Unexpected things happen in business. The better your documentation, the better your business will run while you're gone. When I go on vacation several times a year, I don't get phone calls. Yeah, that's because Pam's been with me since 1999, but when Pam's husband passed away, she wasn't here. I was on an island. The COO had her baby 6 weeks early, she was gone. Our project manager who was next was on vacation in Tahiti. Our attorney that was next in line was in Washington DC testifying in front of Congress. Like the top 5 people were gone. So guess how many phone calls I got while I'm on the beach? None. Because everything we have is manualized. If you want to know how to do something, you pull up a form that tells you how to do it, right? That's what you need to get in place and organize so that the business can run without you, okay? All right. So with the POA, you can name anybody you want. Doesn't need to be a relative, but it needs to be 2 things. Somebody over the age of 18, and it has to be somebody you trust. Because you're going to give them power to do things. And where you can limit the power, it does not make sense to limit the power. It defeats the purpose of the power of attorney. Okay? My daughter has a power of attorney for us. If my wife and I are in a car accident and we're in a coma for 2 years, not on life support because we already said on that part, but we're in a coma for 2 years and we're laying in bed, if the money runs out in the bank, she needs to be able to sell one of our buildings to generate income. But if I've limited her power of attorney and said she cannot sell property, then guess what? She's stuck with this property and can't help us anymore. Okay, so it needs to be somebody that you trust. It can be revoked at any time, so you can revoke the power of attorney. Okay. All right. In between these 2 is something called a living trust, which I didn't put on there. A living trust is a document that changes the ownership of whatever you want, whatever asset you want to change. And when you change it, what happens is that asset no longer is yours, it's the person who you leave it in trust for. Now you might say, why would I do that? Don't you hear all the time on TV when you're watching rich people shows and they all talk about my trust fund, my trust, right? You do it to protect yourself, okay? So let's say I have a piece of property, you can't owe anything on it because the lender's not gonna let you change the name on the deed. But if you don't know anything on it, you can take a house and you can say, the house is Amin Walker in trust for Anaya Nicole Johnson, who's my granddaughter, okay? That property basically belongs to the trust now. It doesn't belong to me. So if somebody sues me, they cannot take that property that's in that trust. At the same time, I completely control the trust until I die. So if I want to sell the property or take a loan out against the property or anything like that, I can do it. Same thing with a bank account. That's a simpler example. You can take money, put it in a bank, put it in a trust account for a child, and the person whose name is on the trust can't touch it. The IRS can't touch it if they're suing you or you owe back taxes. If somebody's suing you personally, it's not part of your personal assets, but yet you get to put money in it or take money out however you want to. You control the trust. Now what happens is as soon as you die, that trust goes to whoever you've named in the trust.
What if you
And
owe,
it's,
what if you owe on it when it goes to,
you can't put it in trust if you owe money on it,
okay.
because your lender is not gonna let you change the title information because
Well,
of the
I
loan.
thought you just said that if you,
Well, so let's say it's, when you put it in trust, there's no lien, but later you wanna borrow
Right.
money against it, yes, that loan will be in the trust name, so that's fine. When you die, the child will inherit that loan as well
Okay,
as the
that's
property. Okay, so at any rate, so when you die, that automatically becomes the person's you name in the trust, and it is completely outside of the probate of your estate. Meaning, if you have a child that comes out of the woodwork after you die and tries to claim your estate, and it holds up your estate processing, which is called probating your estate, the trust item is completely separate. It automatically goes to them, okay? So it's not part of your estate, okay? So that's one of the things that you might want to start thinking about doing. All right, last will and testament. So if you die in Louisiana without a will, you die intestate. That means you die without a will. Once you die without a will, the court system in Louisiana law dictates how your property is distributed. And there is a succession, there is a line of succession. Okay, so let's say my wife and I are married, we have one daughter. Let's just say we have 2 children. I just want to use this example. We have 2 children. We both die. If I die, most people think my wife, community property, she's going to get my half. She does not. Okay, she gets half of my half, and my children get the other half of my half. That's what the example she was using when she said she had to sign it. They had to go execute documents to give it back to her mother. Okay, so even the company, even the joint house together, the wife does not inherit the whole house. She inherits half of the half, so 25%. So now she has 75%, but the 2 children get 25%. Now, if the 2 children, if one of the children is alive and the other child has died, the other one who's died, children gets their part. It doesn't all go to the one remaining son. So you have to be able to dictate how you want your estate to happen, what you want to go. Because I use the example, what if my wife and I are together, we die in a car accident, we have 2 children. One of them is 28 years old, he's married, he finished college, he's got a great job, he's got a good child, he's never been in trouble. And then you got one that's 26, that's a drug addict, has been in and out of jail, and whatever. When you die without a will, those 2 boys are going to equally inherit everything. You need to be able to disinherit somebody if you want to. And the age doesn't matter on that. They could be 40 years old. Those 2 children are going to inherit and split your estate. Okay? On top of that, so the only rule where you cannot disinherit somebody is called a forced heir. That means a child that is 23 years or younger, you cannot cut out of a will. It doesn't matter if you say, I'm only leaving it to this son, you cannot cut that 23-year-old out of the will. You also cannot cut a person out of the will who is any age that is mentally disabled. They're called forced heirs. Now, there is a workaround, or not a workaround, there is an actual law that says when you can disinherit a forced heir, but it's only one case, which is you have proof that they tried to kill you.
Oh, Lord.
Well, it happens. I mean, you got a son that's 21 on drugs, and they go crazy on you because you won't give them money, and they choke you and whatever, and you call the police and say, you choked me, and whatever. You've got a police report that shows this person physically tried to harm you. So you can disinherit them even if they're 21 years old at that point. Okay? So need to lay this out and determine where you want your stuff, how you want your stuff. And she mentioned every 5 years because stuff changes in your life. Now, if it's a pretty simple will that you just say, I want everything I have to go to this person, it doesn't really matter what changes in your life, unless that person, you don't like that person anymore, then you change your will, right? Which you can do at any time. You can take somebody in or out of your will. But particularly, I'm going to tell you a quick short ghost story, Uncle Rudy. Never believed in ghosts till Uncle Rudy. So Uncle Rudy wanted me to have this boat because he and I used to go fishing when I was younger. And in fact, about a year before he died, he brought the boat over to our house. He parked it in our backyard and he said, this is your boat, whatever. But guess what he didn't do? He didn't change his will. So his son sold the boat right out of our backyard. The first time the people took the boat out, they forgot to put the stopper in it. They had to come back in. Bailed it out a little bit, took it back out, went over a waterfall. One broke its back and the other one did something too. So he didn't do it in the will. He didn't leave it to me. So it didn't matter that he promised it to me, that he told it to me, that he even brought it over to the house and gave it to me. Okay? Here, rest of Uncle Rudy ghost story. So he also said he had this Cadillac that he loved because he always said he wanted to buy a Cadillac. So he bought this Cadillac about a year before he died. And he was driving home with his wife, Aretha, and they...
30 days.
Oh, it was only 30 days, that's
And
right.
he said,
It was only a
"Rita,
month.
nobody
He said, he told his wife,
drive
that
my
nobody drive my Cadillac and nobody get my Cadillac. They were driving, he pulled over, they walked across the street, he kissed her, he said, I love you, he dropped dead, and the car blew up. Second thing. Third thing, she was religious and he was not. He said, I do not want to be buried in a church. Again, that's something you can put in your will. I do not want to be buried or have services in a church. His wife was very religious, said, I don't care, have him in church. Carrying a casket into the church, the brick facades of the church collapsed. They got to drop the casket
Bricks
and
fell
fall
off
all over
the front of the
Yes.
building
Yes.
while they were walking
Yes.
and the man
into the church.
This is
That is Uncle Rudy.
This is my uncle too.
Yeah.
Needless to say, the organ that he gave us, they did not sell.
Yes,
that.
they ended up not selling the organ that he gave my sister that was at the house at that point. Okay, so the living will, the last will and testament we need to do. The living will comes in several different facets. The first part says whether you want to be kept alive if on machines, if you have no brain activity and you're being kept alive. The second one says whether you want to be force-fed or not. The third one says whether you want to be resuscitated or not, whether you have a DNR order. And the fourth part is a healthcare power of attorney for somebody specifically designed to only make healthcare decisions for you. Okay, now a couple of things about that. One, if you go in for an elective surgery, gallbladder out, hysterectomy, it doesn't matter what it is. You go in for a surgery, you're cognizant, you're aware, they're gonna ask you when they're checking you in, do you have a living will? If you don't, what do you want to happen? You can make that decision without having a living will because you're cognizant. But the problem is, most of the time you're not too cognizant when you go into the ER, right? You've been in a car accident, you might be awake, but your head's woozy because you hit your head. That's not legally binding for them to ask you what to do. So if you don't have a living will, you will just stay on indefinitely until somebody, you heard of court cases where people have to go fight in court to get somebody taken off of life support, okay? So if you're gonna do this, it needs to be somebody that's gonna make a logical decision. If you do not wanna be on life support system, do not give it to somebody who's not going to honor your wish and take you off of it. I've got a sister, which one? Manir, I'm gonna say her name, I'm gonna call her out. She would, it doesn't matter if she knew I wanted to be off of life support or not, she would leave me on life support forever, hoping that one day the medicine's gonna change enough that they're gonna be able to bring me back. Okay? So she would never be my person I would name in the living will. I named this one, because she's logical. She knows, she loves me, but she knows I don't wanna be like that, let it go. Okay? So again, we do these. It's interesting because I asked somebody the other day, yesterday, they said they had just gotten a will done. I said, who did it? They told me the attorney's name. I said, oh, okay, I know who that was. How much was it? They said, It was $450, but it was, but it was my price because I do so much business with her. I was like, okay. So by the way, because I'm a notary public as well, I write power of attorneys, wills, trusts, and all that stuff. We do these, a power of attorney, a will, and a living trust for $400 for our clients. So all of them together. So if you want to get something done, we just need to get together and put it together, okay? All right, promise, that's the last selling. All right, so now let's run through real quick some controlling your expenses, because this is really, really important. You need to make a plan, you need to have a plan. You need to not buy things last minute. If you use a lot of paper, it doesn't go bad. Yes.
Perfect example, I get my toner for my printers from Amazon. And I get 4 toners for $35. I got another printer identical to the other printers, but it really wasn't. It took a different toner. So when I went into my storeroom to put the toner in the printer, when it ran out, it was a different toner. I had to go to Office Depot. I bought 1 toner for $85.
Plan.
Because I didn't realize,
Right.
even though they were same printer, it was a newer model, different toner. So don't buy last minute.
Planning. Okay, so same thing, like I use the example of paper, Office Depot puts a box of paper on sale about every 3 or 4 weeks for $29.99 for a box of 10 reams of 500 papers, okay? When it's not on sale, you're gonna pay $59.99. So if you know you need it, it doesn't go bad. Keep a couple of boxes in there. When you get down to the last one, go ahead and wait, and you can wait until it goes back on sale. But if you have to do it last minute, it's gonna cost you money, okay? So just be careful, but make a plan on your expenses, okay? Track your expenses regularly. For most of our monthly clients, that means monthly. We send you your monthly report, you get to look at what you spent money on, how much you brought money in, right? Whatever that time frame is for you, you do that yourself, okay? Benchmark against your industry. So one of the things that I'm gonna do for everybody in here, it's normally, I always do it for my clients, but it's normally, I charge $1,700 to do this for people. I will run an industry analysis. I will take your type of business for Baton Rouge. Sometimes I have to expand it to Louisiana because I try to get a sample of about 100 companies. And I will do a industry analysis that tells you, here's how much other people doing what you are doing are making as an average, how much they're making, how much they're spending in rent, how much they're spending in utilities, how much they're spending in employee expenses, everything. And here's how much the average owner's wages are in both dollars and percentages. And those are both important, dollars and percentages. You need to be looking at those versus what you're doing. And those are just going to be average. So obviously you need to try to be above in all of them. But what it allows you to do when you actually look at hard numbers is you might look and say, well, in my industry, they only make 12%, but I'm actually at 16%. That's great, right? But what if they're doing $1 million in sales and you're only doing $550,000 in sales? Now 16% ain't so great, okay? So, but that lets you know, okay, so from what I'm bringing in to what I'm spending, it seems like my expenses might be in line. Now I need to figure out why my revenues aren't in line. Am I not charging enough for my services? Am I not selling enough high dollar services? Why am I not making what they're making? Am I not advertising properly? You can start to look at those things. If you're making about the same money, but they're making more money in the bottom line, then obviously your problem is when you're spending. And then you can start to look at, where am I spending more than them? Every report we give you guys has your dollars and percentages on it, so you can look and see, how do I fall with these things? But these things take planning, these things take attention. I know we send these things out and a lot of people don't even look at them. They just wait till the end of the year. You need to take the time in your business to track the expenses, to benchmark, to look and see what's going on. Can I give you an example of looking outside your industry? Almost everybody in here looks at and reads and goes to conferences and stuff in their industry. You look at PI journals and magazines, you maybe go to sessions, whatever. You guys look at real estate stuff typically. Gabe and Todd might keep up on landscaping, you guys keep up on the medical industry, right? But sometimes the best ideas are happening in industries outside of your own. Okay, so here's the example. I based this company a lot off of the concept of a man named George S. May, who was a business consultant in the 20s and 30s. Okay, he went into a dry cleaning business, and this dry cleaning business was a guy named Mr. White, had been in business for over 40 years. Mr. May was in his business for a couple days and was watching him. Mr. White was older. He was watching him run around, up and down, grab the ladder, pull the clothes down, bring them to the front, and give them to the people. After 2 days, Mr. May said, "Hey, Mr. White, you know, I noticed you running around and getting these clothes, and you're not a spring chicken like me." He said, "You know what happened? Last week I was in a meat packing plant. You know what they have there? They have this belt that brings the carcass all around the warehouse, and people cut off their parts, and it keeps them." He said, "If you would put in something that would bring you the clothes, it sure would save you a lot of time, headache, hassle, and money." Mr. White patented the idea. It's the White Stay Evader system, and to this day, 98% of dry cleaners in America have that White Stay Evader system in there. Look next time you go to a dry cleaner, there's a silver and black tag, and you'll notice it says White Stay Evader on it. This was an idea Mr. White had been in the dry cleaning business for 40 years and never thought about it. But Mr. May, who was in a different industry, saw it and told him about it. Okay? So you can't focus on your own industry. You need to look at other industries. Everybody hates car people. Who are the richest people in every town? Car dealers. Why? Because as much as you hate it, they've got an awfully good selling system. Right? Some will misapply it and do it incorrectly. But overall, everyone buys a car. You got to buy it from someone. Right? So look at some of theirs for their selling systems. I'm just saying, try to get outside of your box. Okay? Manage your variable expenses. Your fixed expenses, you're not going to change all that much. Fixed expenses does not mean expenses that do not change from month to month in terms of dollar. Like rent is a fixed expense. It's basically the same every month. But your utilities are an expense. Fixed expense is defined as an expense that you have every month, whether you have business or not. Okay? Whether you make a sale or not, even. So those are the ones that are easy to control. How much you're paying your people. If they're not working, send them home. Don't pay them. If they're wasting time and being unproductive, change that. Send them home. Or do whatever you need to do. This is where you make the doing. Make tough choices on fixed costs. Now, determine for yourself what you need and what you don't need. So here's what I mean by that. My sister's place, I'm gonna pick on her, is a prime example. She just remodeled, redid it. It looks really nice, it does. And she's got this screen, this TV on the wall, so when she's sitting with people in the conference room, they can see what's on it. She can project to the TV or whatever. So she had a computer guy come and set that up and mount it. And then when she expanded her suite, she had to move it from there to the other place, right? Okay, in 2010, I paid $80 for this and $100 for this. It's still working. 9 years later, you guys can read it, right? Hold on, you guys can read it. She has determined that she wanted that other system or needed that other system for whatever reason she decided she needed it. I'm not going to do it just because I want to impress somebody. I don't use it as much. I might not be using it as much as her or whatever. I've got my reasons. I'm just saying, why would I spend a few $100 or $500 or $700 on a TV that's going to break in 4 or 5 years, pay somebody to mount it and do all that stuff, when this serves my purpose as well as that does? Okay? Go ahead and try to justify it.
Okay. The TV on the wall is not a TV. It's a computer that is networked to all of my clients' accounts. So I can pull up my client's account in my conference room from their computer on the network, which is not what
you can plug your computer into there, right there. And
yeah, but the
do same.
computer's in the closet. I can't.
This is Wi-Fi. See it blinking?
Yeah.
So this is the Wi-Fi to your computer, and you can be projecting onto this kind of screen. It doesn't matter. Look, we're going to make the decisions we make in our business for whatever reasons we decide, and that's okay. But what I'm saying is just think about every decision you make, and if you justify that that's what you need to do, then that's fine. Some of you don't remember, she mentioned the crash of 2008. In 2007, I was telling my construction clients, well, we need a truck. We need a heavy-duty truck. Okay, well, do you really need that Ford F-350 Harley-Davidson with leather roof navigation for your guys to go to the job site on? Or do you need a 350 with vinyl seats, air conditioning, and roll-up windows? You're putting your crew in it. So what happened was in 2008, when it crashed, all those people that spent $80,000 on vehicles a year before were saying, man, if we had bought $30,000 ones, we would have $50,000 per truck left over that we still have in the bank to help us get through this time, okay? You need to determine what you need to do the job. One of my things is invest in technology. The next one, I'm not telling you to get the cheapest thing. I'm telling you to get what you need to do the job, okay? QuickBooks is a very labor-intensive program for computers. It doesn't benefit me to buy a computer for here that is a home computer with 4 gigs of RAM and 1.7 megahertz or gigahertz processor and an AMD. My employees would be sitting here waiting 15 minutes to export a report to Excel. So I need to buy a computer that works for them and helps increase the productivity. Okay. Can you tell there's 6 of us? I'm the baby. We're all 1 year apart. She's the next one up. So, okay. So invest in the technology that you need to do the job, to do the business, but don't invest in things that you don't need, or don't invest more in something just because it's fancier or you think it's going to impress somebody. You know what impresses my clients? To know that I drive a $30,000 car because they think I'm not going to overcharge them. Whatever it is, I mean, you know, just take it and think about what you're spending money on and ask yourself, do you really need to spend it or not? Okay? All right. How many employees do you have, Cody?
5 full-time employees.
Okay, so 5. And I'm not worried about part-time. And how much is their average dollar that they make?
I'd say 17.5.
Okay, so let's go with 16. Cody has 5 employees that make $16. If each employee wastes 5 minutes a day, this is what it's costing Cody on an annual basis on his bottom line.
Oh, they do.
And that's if they waste 5 minutes.
I'm pretty sure they always do that.
Wow.
Now, on top of wasting that 5 minutes, if Cody is operating at a 10% profit margin, how much does he have to put on the books to overcome this $3,400? $34,000 in sales so that he can make $3,400 that he can pay his employees to waste 5 minutes.
That's just 5 minutes.
That's just 5 minutes a day. You don't have to be a slave driver, but you have to demand from them. All right, everybody got a piece of paper? All right, if you have employees, I want you to write a number on a piece of paper, 1 being absolutely horrible employees, couldn't be any worse, to 10 being absolutely perfect, couldn't be any better, and just rate all of your employees as a group. So give me like together. I know you probably have 1 that's worse, 1 that's better. Just come on, write a number, just any number.
Out of 10.
Out of 10. 1 being horrible, 10 being perfect. Now, I am going to tell you already, well, I'll do this in a second. Okay, everybody got their number? Everybody got a number down?
Mm-hmm.
Yeah?
Dave, put a number down.
Did I guess right?
You don't know.
7. How many people said 7?
I got 6.
Okay, now, I would have expected Cody to say 8 because he's in a very technical business. I would expect Gabe and Todd to say less because they're in a less technical business. Did you guys say less?
I was gonna say 7.
Okay, well that's good. You're gonna say 7. That's good for your industry. Okay, how would I do that?
I'm surprised.
Well, you have some great people and some okay people. You wouldn't keep them if they weren't all right.
You know, I'm psychic. No, a lot of years experience. Okay, so what I would ask you when you write down a 7 is, Are you okay with paying your people $10 an hour to get $7 worth of work?
No.
No. You don't want to be slave drivers, but you need to demand that your people perform for you and do what you're paying them for.
Then I'm raising my number. My employees are very productive,
Okay.
even if they do waste 5 minutes.
Okay. Mine waits 5 minutes. I'm not
And
saying.
that's on YouTube.
I said no, I'm a slave
tell
driver.
them to go ahead and look this up.
All right, let's roll. Let's roll. We can finish on
It's
time.
that drive
Okay,
home.
so if
It's
you want
that
to
drive home.
you want to put $4,000 in your pocket more at the end of the year. Okay, you want to put $4,000 more in your pocket. And you operate at a 10% profit margin. There are two ways to do that. You can sell $40,000 more in services or product, or you can reduce your expenses and waste by $4,000. What's easier?
Reduction.
Right. Every dollar that you reduce in waste is going to be a dollar you put in your pocket at the end of the year. Every dollar you sell today is only going to put 10 cents in your pocket because you have associated costs with it, right? So we're going to focus on first reducing and then selling. Got it? Let me give you your biggest cost for the company. Turnover. So the Department of Labor classifies a ditch digger as the lowest classification of employee. Now, the reason that they do that, I'm not talking about people that operate heavy equipment and stuff like that. A ditch digger. They say, there's a spot, here's a shovel, dig a hole. Okay? So the Department of Labor has determined that when you lose a ditch digger, it costs your company $2,801. So now start thinking about when you have more skilled people, more educated people, more trained people, how much it's actually costing you to lose somebody. Think about all the costs associated with it. When they're not there, you lose productivity work, right? Okay. Then you have to advertise for it. So maybe you do free advertising or maybe you pay for it. But even if you do free advertising, when we hired Rochelle, actually she came as a crazy kind of way. But at the time I was looking and I had an ad on Indeed and I had like 150 applications. Even though I put need to have this, need to have this, need to have this, still I got applications for people who had none of those things. So I was spending, which, you know, again, my rates are vary. Microsoft pays me $9.75 an hour, Exxon $9.75 an hour. But here, you know, $1.75 an hour or less, depending on the situation, but about that. So every hour I have to spend is an hour I'm not spending billing somebody $175, right? So how many dollars is it costing me to go through 150 applications? Then I get them in and I pick the ones, but I got to interview them. And I interview 5 or 10 of them at a half an hour or 45 minutes each. Now how much more is it costing me? Then I get them and I decide I want to hire them. I send them over to our other company, Walker Investigations, and we do a background check on them. So I got to pay Walker Investigations to do a background check. You might do a drug screening on them, whatever that is, right? Then you're going to bring them on, and what do you have to do after you bring them on? Train them or acclimate them to your to your company. And then once they're trained, it takes a certain amount of time to get them up to speed, to be at the same speed and efficiency as the person who was here before. And God forbid they should happen to piss off one of your customers while you're doing it and you lose a customer, because then you lose a lifetime value of that customer, right? So you need to reduce turnover. It needs to come down, okay? By the way, one quick cost saving tool. How many of you call the personal references? Okay, I'd ask, why do you do that?
I'm trying to get to know the person better without them telling me.
Do you think I'm gonna put anybody on my application that's gonna say something bad? You are completely wasting your time to call personal references. You are better to take their name and put it in Facebook and Instagram and see what pops up. Then you'll see what the person is really about. Okay, don't call them. It's just a waste of time. But there's some things you can do. Select the right people the first time. Just because you need somebody doesn't mean you need to take the first person that comes up. You need to find the right person for the job. Second, you need to train, and cross-train. Okay? You need to start them out with their job or the basics, and then you need to teach them how to do other things once they are comfortable with their current job. Okay? Give them more responsibility. You know, by and large, and some people would tend to disagree, but by and large, people like more responsibility. They don't like to do the same stuff over and over again. They don't like to feel like what they're doing is not important.
That's me.
Yep. Give them more responsibility. Involve them in company decisions. Rochelle doesn't know this because she's new, but you know, when I started, it was just consulting, and then we did the accounting stuff. But all the other services that we added as a group. So what we do is we all sit down and we come up with 3 ideas for a new service that we would want to do here. Okay, well, it might be more than that, but we round it down to 3. And then I have this checklist of stuff, and we rate from 1 to 5 different things. The cost to implement the new service. Is it a 1, which means it's not going to cost as much at all? Is it 5, meaning it's going to cost a lot? Entrance of a competitor. You know, how hard is it for other people to come into this arena if they see we're doing well? You know, how long it will take to get it up and going. Do you need extra staff? We go through this whole list, and so what I do is I say, okay, cost to do it. So idea number 1, we're going to do this. Everybody shout out a number. And everybody shouts out a number. And I say, okay, I hear 2s and I hear 3s. Why is it 2? Why is it 3? Shout out a number. And then once we get everybody on the same accord, I know it sounds like it's long, but it's not long. Once everybody's on the accord, we assign that number to that particular thing. And we do that for all of the things down there. And then when we get done, we add them all up, and the one with the lowest number is the best idea for the business. It's going to be, might not be the easiest to implement, but it might be least expensive. And so it's like a rating system. And that's how we determine what new service we're going to bring into the business. Then once we do that, I will say, okay, Angelique, need you to start looking at or thinking about how people are advertising this service. Richard, I want you to see where should we get our customers from? Are they going to come from schools? Are they going to come from private industry? You're going to look at that. Gabe, I want you to go ahead and start putting together any licensing and legal stuff that we need to go along with this. And everybody has a task, and then we all put this thing together. So what happens by the end is, first of all, everybody's involved. Everybody buys into the idea that we all want to do this new thing, and we all are part of it. So it's going to succeed together or it's going to fail together, but we're not going to have people saying, I ain't going to do that. I don't know why we brought on board, right? So involved in company decisions. It might not have to be that detailed, but get input from your people. You do not know everything, okay? There is a boat captain riding along at night. It's foggy. They see a light coming at them. The radio operator gets on the thing and says, you're in a direct course with us. Please change your course. The voice comes back over the radio and says, you're in a direct course with us. Please change your course. The captain who's standing there gets pissed. He's thinking, what's going on? He grabs the mic and he says, this is Captain Winstead of the USS Navy. You're in a direct course with us. Please move. The other voice comes back and says, well, sir, this is Ensign Brown of the U.S. Navy, and I really think you should move. Captain gets so mad, he says, damn it, we are a USS Destroyer, move now. And the other voice comes back and says, we're a lighthouse. So what just happened to that captain's... He had a paradigm shift. He completely changed the way he was thinking. And the problem is, as business owners, we get tunnel vision. We only see what we want to see. And we're like writers. When we write a book, if somebody writes a book and they read what they meant to write. The editor reads what they really wrote. Okay? So we need to get out of this frame of, I know the best way to do this, and let your people input and help you. Okay? But part of that is, they've got to understand that they're not going to get yelled at and screamed at or fussed at, right? I hope Rochelle knows already at this point that she can come and tell me anything. She's even come and made some suggestions and said it would be better if she did something this way when we have been doing it that way. That's okay. She brings a whole new perspective, right? Let those things happen. Let those things take place. Offer perks that don't cost additional money. You know, up until yesterday, I really only had kind of one that I think is a perk that doesn't cost money, but someone said something interesting yesterday. I call her fashionista because she owns a women's clothing store. She was dressed down, wasn't she? Anyway, and I asked that question, and you know what she said? She said, well, you know, it cost me money before, but it's, you know, I wasn't using it anyway. She said, I let my employee who does the best job in sales come to my house and pick stuff out of my closet that she'd like to have. And true, she paid some money for it at some point for it, but it's not costing her more money. It's not costing the company money. So that's a good part. The one I'm thinking particularly of is the thank yous, the attaboys, so you're doing a good job, those type of things. People need to hear those, they want to hear those, okay? It will, even if it's their job, I will go to my daughter whose job, she does the payroll, and I'll say, hey, you did a great job, thanks for getting all the payrolls out nice and early. Okay, you did your job, right? But that makes it easier when I need to go to her and say, oops, messed something up, so let's be careful or whatever, right? Okay, ask, don't tell. When I walk into an office, and I will walk up to Pam, and I will say, Pam, can you do me a favor? We got this new client, when somebody gets a chance, can you get them to put this in for me? If I just dropped it on a desk and said, Pam, get somebody to put this in, they do it, right? Well, hopefully they do it, I'm the boss, they're supposed to, right? But I ask her, and she knows whenever somebody frees up, there's no hurry, just get it in. Sometimes I will go up to her and I will say, Pam, I really hate to do this to you, but I'm trying to prepare for another meeting I have at 3. This person's coming in at 3:30. Can you stop somebody and get them to put this in for me? Right? I could have went up to her and said, Pam, I need somebody to do this right now. But I've told her what's going on. I've told her why I need it. I told her it's an emergency. I even told her I'm going to be doing something else. Because people's inclination is to think, well, why you don't do it if you need it so fast, right? Because I'm doing something else right now. Can you know? So you get a lot more by asking than telling, right? Okay. Offer praise, regulars of criticism. Make work more relaxed and fun, okay? You don't have to be a slave driver, okay? Yes, you need to demand that your people work, you need to demand that the things get done the way they need to get done. But if people are standing at the front talking for a little while, I don't care. Now, if they're standing there talking and they've had a deadline for the end of the day and I come to them or I need something and they ain't finish it, then I'm gonna be a little upset. But I'm not gonna yell and scream, I'm gonna be a little upset, okay? Provide an opportunity for growth. And the last one, keep communication chains open. I can't tell you how important this is. I know we say it, but that means both directions. That means your employees have to be able to tell you when you're screwing up, okay? I can't tell you how many times Pam has come and told me something. One day, look, we had these doctors that were just in business for like 2 years out of school. They have a practice, and the practice isn't going well. They're really not making any money. They don't have systems in place. And they called me and they said, this other doctor is selling his practice in Baton Rouge and it's only $320,000. And, you know, they want to buy it. And I was like, I don't think you should do that because you got this problem over here, blah, 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 blah. Wife, you're only working 20 hours a week. Husband, you think you're working full-time at 32 hours a week. Y'all need to boost your hours. You need to get that one under control. You need to start making money there and then look at this other one. They totally ended up agreeing. Yeah? I could see it in their eyes that they really didn't want to, but they started agreeing. Call me 2 days later and say, well, you're going to be mad, but he dropped the price $20,000 and we just couldn't resist, so we signed the paperwork yesterday. And I was like, well, you know what? That's a decision you made. That's fine. No problem. And I was done with the phone call. And Pam was like, you need to call him back and apologize because you didn't hear the tone of your voice, you know? And I called him back and I said, look, I might have sounded rough, you know, we're going to be here to support you whatever we can to make sure that you are successful in all of them, whatever. But, you know, your people need to be able to tell you that. My people will tell me, I am a procrastinator. I know I'm a procrastinator. I did this slide the night before the first seminar, right? My wife, when she sat in on the first day, said she did her homework on the way home from school each day on the bus because then she'd have the rest of the day and the weekend and stuff. I always did mine on the way on the bus to school,
That's me.
right?
So then you still have a whole weekend.
I was a procrastinator, okay? So I need them to come to me sometimes and say, you need to stop what you're doing there and do this thing that's due on Friday, because once you're done this, on Friday it's done. Then you can work on the other things that don't have the same time restraints. But your people need to be able to tell you that. They need to be able to tell you when you're screwing up, and you need to understand that it's for the betterment of the company, not your ego.
Right.
Okay? All right, so that's it. Any questions, anything that you thought I was going to cover that I did not cover? Okay, so from here, what I'm going to do, I'm going to email everybody. I've got to get on the road to Houston. But I'm gonna email everybody the slideshow presentation, I'm gonna email everybody the 1099 versus employee labor, and I'm gonna email you her presentation from earlier, okay? And then, if you would like an industry financial, well, I'm gonna run them all anyway, so I'll just send you those, but those are gonna take a while, cause when I run those things, they take about, 6 hours to run each, cause I'm pulling tax return data, national and state, and I'm pulling data from all over the place. Okay? Thank you, everybody, for coming, and, you know we're here for whatever you need.
Awesome job.
Yes, thank you.
Very important.
Can you hit my stop, Cody?